Hello and welcome to Session 18 of the Basic Tax course. We're going to begin Session 18 with a review of the Session 17 quiz answer key, beginning with question number 2. Recovery for depreciation claimed on a rental property is taxed at a maximum rate of which of the following? As you recall in our review of the Session 15-16 quiz, I mentioned that when you sell real estate, any depreciation you recover on that is taxed as a capital gain, and the maximum rate is 25%. And of course, I've said it more than in that review. It's been discussed in the lectures as well, but this particular quiz problem is coming back to that concept. How is capital gain on the sale of real estate taxed? If the real estate was depreciable and eligible for depreciation deductions, and then you sell that real estate and you sell it at a gain, the portion of that gain that is attributable to previously claimed depreciation is taxed as recovery property. And the maximum rate of taxation on recovery property is 25%, and that is why D is the correct answer. Question number 6. On 1/8/03, Jerry purchased 300 shares of ABC stock for $15 per share. On 8/10/06, there was a 2-for-1 split. And then on 10/10/12, Jerry sold 300 shares of ABC stock for $14 per share. What is his net gain or loss? Well, we just look at the component parts here. In 2003, he purchases 300 shares at $15 per share, but then 3 years later, there's a 2-for-1 split. So essentially, he's now going to hold 600 shares at a cost of $7.50 per share. If he then turns around and sells 300 shares, you're going to take $7.50 times 300 shares to get his $2,250 cost basis in the 300 shares that were sold. He then sells those 300 shares for $14 a share. 300 times 14 is $4,200, and then you simply take $4,200 minus the cost basis of $2,250, and you're left with $1,950. Is the gain long-term or short-term? Well, clearly he held the stock for more than 1 year. It is a long-term capital gain. Question number 7. On 1/1/12, Fred inherited 100 shares of ABC stock from his father, who died on 12/1/11. Fred's father purchased the ABC stock back in 2007 for $3,000. The stock had a fair market value on the date of Fred's father's death of $5,500. Then on 1/5/2012, Fred sold the stock for $5,000. What will his gain or loss be? Well, when we're dealing with inherited property, we do not look to the cost basis of the decedent. Instead, we look to the fair market value of the property either on the date of death or 6 months later, and most of the time we look to the date of death. In this situation, on the date of death, the stock had a fair market value of $5,500. If Fred turns around and sells it for $5,000, he's actually selling it at a loss. And even though he held the stock for what appears to be less than a year, just a couple of months, it happens to be the case that your basis in inherited property is always considered to be long-term, or your holding period for inherited property is always considered to be long-term, and therefore we have a $500 long-term loss. Question number 8, which of the following is not Section 1231 property? Just remembering what the definition of Section 1231 property is. Section 1231 property is any asset held for use in a business that is subject to depreciation. And so when we look at the types of property listed, we can see inventory, rental real estate, office furniture, or a breeding cow. B, C, and D are all depreciable assets, but inventory is not depreciable. And so when we look for which of the following is not Section 1231 property, the only piece of property that is not depreciable is the inventory, and therefore inventory is not Section 1231 property. Question number 11. Mr. J purchased a new business use car for $12,000. As down payment, he traded in his old car, which had an adjusted basis of $3,000. The seller of the new car allowed Mr. J a trade-in value of $2,000. So how should Mr. J recognize this transaction on his tax return? Well, this is going to be a like-kind exchange. You trade in one car for another car, that makes it a like-kind exchange. One type of property for property of the same class, like-kind exchange. Then we're looking at how do we determine cost basis. Well, his adjusted basis in the old car is $3,000. And he's being given a $2,000 trade-in on that car. So it means that he's going to have to bring some cash to the table. If the acquisition cost of the new vehicle is $12,000, but they only give him $2,000 as trade-in, it means he's going to have to come up with that $1,000 spread to determine his basis in the new car. And so he is going to have a basis in the new car of $13,000. We essentially take 12 minus 2, add back in 3, and that's where you get $13,000. That's his basis in the new car. Question number 14, a non-business personal bad debt becomes deductible in the year it becomes worthless as B, a short-term loss on Schedule D. That's just a fact you need to know. In other words, bad debt is treated as short-term even if the debt itself was held long-term. So that concludes this review of the Session 17 quiz. It is now time to begin with the Session 18 lecture. All right, welcome to today's presentation called Sale of Home, Installment Sale, and Like-Kind Exchanges. So the first topic of the day is Sale of Home. And Sale of Home is a topic that you'd think of as, that's simple. People don't have to pay tax when they sell their home anymore because, after all, you know, we have that $250,000 exclusion if you're single, $500,000 if you're married. So people don't really get taxed when they sell their home anyway, so what's there to talk about? Well, you'll find out with today's class that there's plenty to talk about. And, of course, IRS has an entire publication devoted to this one topic alone. It's IRS Publication 523, Selling Your Home. And it's a decent read. If you have a feeling or a need to more educate yourself on the topic, you can just print that publication out and entertain yourself with it. The introduction is that your home is considered to be a personal use asset, and the following tax rules normally apply to the sale of personal use assets. And the first rule is that the loss on the sale of a personal use capital asset is not normally reportable, and any loss is not deductible. So for the most part, when you sell an asset that's a personal use asset, likelihood is you've sold it at a loss, you just don't report anything. But if you sell a personal use asset at a profit, it is taxable. And then you have this rule that says the gain on the sale of a personal use asset is taxable, but if the asset is your home, you might be able to get away from that. So the general rule is when you have a sale of a personal use asset, the loss is not deductible, but any gain is taxable. So when it comes to the sale of your main home, however, special rules may allow you to exclude a portion or all of your gain, making the sale of your home a tax-free event. And this course is going to describe the rules surrounding the sale of your home and how to determine what portion of gain may be received tax-free when the home is sold. Now, we have really two independent sets of rules that we've operated under over the last couple of decades. And when I first got into the tax preparation industry, we lived at that time in a world where if you did sell your home, the gain could be taxed. And it wasn't until May 7, 1997 that the exclusion rules came into play, where you could exclude gain when you sold your home and not pay tax on it. So up until that May 7 date, people did have gains on homes that could be taxed, but there was a way out of it, and the way out of it was to do something almost like a like-kind exchange. It wasn't a like-kind exchange, but kind of worked the same way as a like-kind exchange. And under those rules of that time, what you could do is you could sell your home, and if within 2 years you purchased a home of equal or greater value, then you could defer paying tax on any gain from the sale of the original home. And people did that by filing a form called 2119. And the thing is that although 1997 seems like a long time ago now, it's not going to be that hard to find people who've been in their homes since before 1997. And if you did purchase your home before 1997, and then you purchased that home after selling another home, and when you sold that other home, you filed 2119 when you bought the new home, then you have a situation where you have someone who has a deferred gain. So that's going to be the first topic of the day. So there is room for some confusion when it comes to selling your home. The rules for sale of your home changed completely beginning in 1997, and many homeowners today currently own homes that they bought under rules that existed in 1997 and earlier years. Did you file Form 2119 to postpone gain on the sale of your home before May 7, 1997? Prior to May 7, 1997, gain on the sale of your home was fully taxable. However, if you bought a replacement home that was equal to or greater in value than your old home, you would have filed Form 2119 to postpone your gain. Postponement of gain on sale of home effectively reduced your cost basis in the new home. And this is relevant today if you are trying to calculate the gain on the sale of a home for which you previously filed Form 2119. So the way that deferral worked is, let's just suppose I go back to, 1990. I buy a house. And I pay $100,000 for that house. And then I sell that house in 1995 for $200,000. I have a $100,000 profit. But I turn around within 2 years, let's say 1997, and I buy that replacement home for $250,000. The new home costs more than the sales price of the old home, and therefore I'm able to defer my gain on the sale of the old home. But that deferral of gain reduces my basis in the new home. So if the purchase price of the new home is $250,000, but I exclude or defer $100,000 of gain on the sale of the old home, then it really means my basis in the new home is $150,000. So that is how those rules work, and they're relevant today because if you have a person who has a gain that was deferred in an earlier year because they filed Form 2119, it's going to have an effect on the basis of the home that they own today. And if they sell the home today and they sell it for a gain, and you wish to go ahead and claim that exclusion for gain on the sale of home, you have to work from the reduced basis of that home rather than the actual purchase price of the home. So that's a relevant fact to keep in mind. And really the main reason we mention it is that when you are figuring the gain and how much gain to exclude and how much gain can be excluded, you have to factor in any gain that may previously been deferred because 2119 was filed. Now also back in those days, there was a rule that allowed a person once in their lifetime to exclude up to $125,000 of gain from their income. And it was available to them when they turned age 55. And so if a person turned age 55, they were allowed to sell their home and exclude their gain on the sale of that home of up to $125,000. But they could only do it once in their lifetime. And that, of course, has gone away. That rule no longer exists. But it's important to know that just because a person did claim the once-in-a-lifetime exclusion of $125,000, it's not going to preclude them from being able to claim the exclusions that are in existence today. And I do remember in my early years as a tax preparer, lots of people were talking about when they reached age 55, they were going to sell their home because they were going to take advantage of the once-in-a-lifetime exclusion after they turned age 55. And a number of people I worked with over the years and had conversations with over the years were waiting for that magic date that they turned 55. But of course, today it is no longer relevant. Sale of home after May 6, 1997, and of course, today we exist in a world that is after May 6, 1997, and so these are the rules that are in play today. If you sold your home in 2012, you may exclude up to $250,000 of gain or $500,000 if you are married filing joint. Excluding gain of the sale of a home under Section 121, because it's Section 121 that spells out all the rules about how you are allowed to do this. You can qualify to exclude gain on the sale of your main home if you owned and lived in the home for 2 out of the last 5 years. So what is a main home? Well, your main home is generally the home that you live in most of the time. If you own 2 or more homes, only one of those homes is your main home. Your main home can be any of the following: a houseboat, a mobile home, an apartment, or a condominium. A reduced maximum exclusion. Generally, you may only claim the exclusion for gain on the sale of your home once every 2 years. However, you may still be entitled to claim a partial exclusion if you sold your home sooner than 2 years after you last claimed the exclusion, or sooner than 2 years after you purchased your home. If you sold your home because you either had a change in health, you changed your place of employment, or other unforeseen circumstances. If you qualify for the reduced exclusion, you may claim the exclusion on the sale of your home for a prorated amount that is based upon the length of time you lived in your home during a 2-year period. And here's an illustration on how that works, figuring a reduced exclusion. Sam bought his home on 10/10 of 10 for $150,000. Then on 1/10 of 12, he moved to Arizona to begin working at a new job. He sold his home for $180,000. Sam can exclude all of his gain as follows. He looks at the number of months in 2 years, which is 24, and he divides that by the number of months he actually owned and lived in the home, which is 15 months. And he gets a ratio. He then multiplies that ratio by the maximum exclusion amount of $250,000, and he's left with the amount that is the maximum amount he is allowed to exclude, $156,250. Well, it's pretty obvious that the amount he's allowed to exclude is far greater than his gain of $30,000. Because he buys for $150, sells for $180, the gain is $30. He's not going to get taxed on the gain. He'll be allowed to exclude it all. Now, how do you figure your gain or loss on the sale of home? In that earlier example, I just showed you real simple. He sells for $180 and he pays $150. There's this $30,000 profit. It's technically a little more complicated than that. Anytime you're dealing with a capital asset, you are dealing with many, many factors that go into calculating out the basis. So we're going to talk about some of those. So to accurately figure your gain or loss on the sale of your home, the first thing you need to do is keep records. And what many people don't realize is how long they have to keep those records for. Now, if you've lived in a house for 14 years, 15 years, 20 years, every time you make an improvement to that home, you're supposed to keep documentation proving that you made that improvement. And the thing is, after time, people start to accumulate piles of documents and piles of receipts, and they really wonder if they need to save that all, and they feel a need to purge and get rid of it all. And the dilemma is that when you're dealing with a capital asset, you do need to keep those records for as long as you own the property at issue, and then really for 2 years after you dispose of it. So if you lived in your home for 20 years, you would need to keep the records for your home for 23 years. For the 20 years you lived in it, and then for the 3 years after you sell it. Because in the 3 years after you sell it, that's where you're going to report the transaction on your tax return, and IRS says from that point you need to have the records for 3 years in case they decide to audit you and require you to prove that information. So what kind of records do you need to keep? To prove your cost basis in your home, you should keep all of the following records: receipts or other written records of any improvements you make to the home, including landscaping, new roof, new plumbing, new wiring, improvements like home additions, decks, patios, fences, etc., remodeling costs for kitchens, baths, basements, etc., closing papers from the purchase and sale of your home and from any refinances from home equity loans used for home improvement, and records for any depreciation you may have claimed for business use of your home. And here's an illustration of how all of these different items can go into affecting the basis for a person's home. Mr. and Mrs. Harper bought their home back in 1990 for $70,000. Their closing papers show that they paid an additional $1,500 in closing costs. Then on 5/10 of 98, they refinanced their home for $150,000 and used all of the proceeds of the loan to remodel and make improvements to the home. They paid $1,500 in closing costs for that refinance. Then on 8/10 of 7, they refinanced their home again, this time for $250,000. This time, the proceeds were used to pay off credit card and car loan debt. But there was $5,000 held out that was spent to replace the roof, and a roof replacement is considered to be an improvement. And at that time, they paid $2,500 in closing costs. Well, what I'm looking at in these two scenarios here is we have closing costs paid on the purchase, and you're going to add those to the purchase price of the house. Those will add to basis. You also look at the money that's taken out on a home equity loan and how it's spent. If it's spent on home improvement, then that would add to basis. And then they have $1,500 in closing costs from a refinance, the purpose of which was to improve the home. So we're going to add that $1,500 to the basis as well. Then we have the refinance where money was really spent on other things. It wasn't spent on the home for the most part. But we do have $5,000 that was spent on the home. So we will add the $5,000 to the basis of the home, but really not the closing costs because they're not incidental to the home improvement. They were really for another purpose, which is to get money to pay off other kinds of debt. Then on 8/9 of 12, they sold their home for $285,000. They paid $17,100 in real estate commissions to their agent and then another $2,500 in closing costs. The remaining balance owed on their mortgage at the time of the sale was $243,000. So how do we figure the gain on the sale for Mr. and Mrs. Harper? You're going to have to add up the following amounts. We start with a purchase price of $70,000. We look at the closing costs paid on purchase. We then add in amounts paid for home improvements and the closing costs on the loan taken out to make those home improvements. And then we look at the amount paid for home improvements back in 2007. And we add all of that up and we have $158,000. So that's what we call their adjusted basis. We then go over to the sales price of the home, $285,000, and from that we subtract closing costs on the sale and commissions on the sale to get the amount realized from the sale. We have a net profit or a gain realized on the sale of $265,400 minus the $158,000 of adjusted basis, and here we have a profit. The profit is $107,400. Now, no tax is going to be owed on that profit because it is less than the $500,000 of exclusion amount that Mr. and Mrs. Harper can claim. So, for all intents and purposes, nothing needs to be reported on the tax return at all. There's no need to report this information because there is no taxable gain. Now, there can be a different situation, however, and that different situation is that if they get a 1099-S reporting the sale, that 1099-S will be filed with the IRS as well. And so the IRS is going to look to their tax return to see a reporting of the sale because a 1099-S is floating around. And if you actually go into the Sale of Home Publication 523 and read the instructions in there, one of the reasons it'll say that you're required to report the sale of a home is if you get that 1099-S, and it's kind of obvious why that would trigger a need. But if you don't have a 1099-S and you don't have a taxable gain because you're eligible for that exclusion, nothing even gets reported. Now, one of the other things to make note of, and I don't run across this problem so much today as I did in the pre-1997 days. People would come to me at that point because they'd sold their home, and we'd be going through and figuring out whether or not they had to pay tax on that gain. And I can remember clients being very confused. They would sell the home and they'd get a certain amount of money left over after all the closing expenses had been paid and all of the mortgages had been paid off. They'd have a certain amount of money in their hands. They'd get a check for a certain amount. And that was what they thought their profit was, that they'd have to pay their tax on. But that's not actually how it works at all. You can see here that in this situation, we've arrived at a profit of $107,400. But how much cash do they actually walk away from the sale with? So here we have an illustration of how that works. Mr. and Mrs. Harper have a cost basis in their home of $158,000. However, because they refinanced their home in 2007 for $250,000, at the time they paid off their old mortgage, the loan balance on that sale at the time of sale was $243,000. So the sales proceeds of $265,400 are enough to pay off the $243,000, and once you've done that, you're left with $22,400 of cash. The $22,400 of cash has absolutely nothing to do with the profit realized on the sale, but in the mind of the taxpayer, it could. And it's just been my experience that they often think that way. And quite frankly, I've run across one or two tax preparers who think that way as well. So it is important to disassociate those two things. Now, in the sale of a home, it's not going to matter as much because the exclusion is probably going to make it all tax-free anyway. But if you've got a client who's sold a rental property, you could see their mind working in exactly the same direction, that the amount of cash they walk away from the sale from should be the amount they have to pay tax on. And even today, I still get clients who think that. And of course, that's not the case. So reporting rules for sale of home. Generally, if you meet the rules for excluding the entire gain from the sale of your home, there is no need to report the sale of your home on your tax return. However, you should report the sale of your home on your return if either of the following is true. Number one, you received Form 1099-S, or your gain from the sale of a home is greater than your exclusion amount. Now, prior to 1998, taxpayers were required to report the sale of home using Form 2119. Form 2119 is no longer in use. If you're required to report the sale of your home, you're going to use Schedule D and Form 8949. If you claimed depreciation on your home after May 6, 1997, you should report any recovery of depreciation on Schedule D, line 19, and then complete the Section 1250 gain worksheet. Now, our company uses Drake software, and you'll hear me mention that frequently in my classes. And one of the things that I've noticed in Drake software that may or may not confuse other people who work on it is that Drake actually has a worksheet built into it for figuring the taxable gain on the sale of your home. And the title of the worksheet is the 2119 worksheet. And for people who weren't around in the days or don't remember the days when we had a Form 2119, it might seem a little odd that Drake is using that title for that worksheet. But for me, I can see why they're using it, even though I think technically it's probably an obsolete title and they should probably just call it the Sale of Home Worksheet. They do still call it the 2119 Worksheet. Here's an illustration of how you would report the sale of a home when the reporting of the sale is required. On February 5, 2012, Peter and Betty, homeowner, sold their home for $795,000. The homeowners purchased their home back on 3/5 of 1970 for $20,000. And over the years, they spent $12,250 on improvements to their home, and they paid $40,000 in commissions and other selling expenses. They received a Form 1099-S from their title company, calculate and report the homeowner's taxable gain from the sale of their home as follows. Now, one of the things that one of my staff noticed is that when IRS changed the Schedule D and introduced Form 8949 with its codes for adjustments, they actually did kind of a hokey weird thing with sale of home. And I'm going to show you what it is. And the double weirdness of it is that it works only when you sell the home and there is no taxable gain. If you sell the home and there is a taxable gain because there was business use of the home, then they don't do it in the same way. So there's really two different ways that IRS is dealing with sale of the home on Form 8949. And when you are able to exclude the gain and none of the profit on the sale is associated with business use of the home, only capital gain use of the home, they have you report it in a way that is rather odd. And it's so odd that I didn't even notice it for the first year I was teaching this class. And Drake Software still is handling it in the way that I would have thought it should be handled, but it's not in compliance with the IRS instructions anymore. So I'm going to show you what the IRS is instructing, and maybe you'll understand why I'm rambling on like this. So here we have an illustration where we've purchased the house a long time ago for $20,000, back in the days when you could buy a house for $20,000. And over the years, they didn't spend a lot on improvements at all, $12,250. So there's an adjusted basis in the home of $32,250. The home is sold for $795,000, and we subtract out this adjusted basis amount of $32,250 to get a gain on the sale of $762,750. Now we have some expenses of the sale, $40,000. And in general, when you're looking at the rules for capital gains, expenses of the sale add to your basis. So it makes sense that this $40,000 would go over here and affect the adjusted basis of the home. But the way IRS wants you doing the sale of home today, they're saying no, keep this amount out separate and add it to the exclusion amount. So their exclusion amount is $500,000. They're going to use it in full because the gain on the sale is more than the exclusion amount. And so IRS says take the expenses of the sale, add those to the exclusion amount, and then enter those on the adjustment line of the 8949. The net gain is $222,750. Now, ultimately, it wouldn't matter whether I put the $40,000 here as an adjustment to gain or over here as an addition to the adjusted basis. Either way, I get the same taxable amount. So I don't know that it's a crucial problem if you do it one way over another, but today I'm going to teach you exactly how the IRS instructions are telling you to do it. So here we have Peter and Betty homeowner. They have received a 1099-S, and it's showing the gross proceeds from the sale are $795,000. As a general rule, when you have a reporting document that shows a certain amount of income or gross proceeds were received from a sale, you want to make sure that whatever number is on that document makes its way to the 8949 in the exact same amount, never a less amount. It could be more, but it could never be less. Because if it is less, it's going to trigger a CP2000 letter. So my starting point is to pull that gross proceeds down and enter that down as the sales price. We then go over to the column A. We enter a description. The description that the IRS wants you to enter is main home. We enter the date acquired. We enter the date sold. And then we enter the cost basis. Now, logically speaking, I would think that the cost basis is $72,250, but IRS says, no, keep the selling expenses off this line and just enter the adjusted basis without regard to selling expense. So we do that, $32,250, and then we go over to column F, and IRS says, enter codes in this column to indicate reasons for adjustment. And there are two reasons for adjustment. The first reason is code E, and we use that to indicate that there were selling expenses. And the second reason is code H, and we use that to indicate that we are claiming the exclusion amount for sale of a home for a married couple. Not specifically for a married couple, but we are claiming it for a married couple. So code EH are combined on column F, and then in column G, we enter the combined exclusion amount of $540, and when we're done, we end up with that gain amount, $22,750. I think I've got an error up top. April's math is off somewhere. So here we have the gain, $22,750. It's taxable, and so we're going to carry that over. It's just this form that's wrong. I know why it's wrong. Drake couldn't do the form, and so I was manually entering numbers. and I left off a 2. So this is supposed to be 222,750. Got it? And then we go over and we got this part right, 222,750. So that's all straightened out. So this is the net gain, and it's taxable, and it's going to be taxable for 2012 at a maximum rate of 15% on the federal return. And of course, for 2013, capital gain rates are going up depending on your income. Recapture of depreciation on the sale of the home. Well, most people can take advantage of the $250,000 or $500,000 exclusion amount on the sale of their home. There are still instances where the sale of the home can result in a taxable gain, even when the overall gain is less than the exclusion amount. So in our example here with Peter and Betty Homemaker, the gain exceeds their exclusion amount. That's why they still have to pay tax. But there are situations where the gain can exceed the exclusion amount, and they're still going to have to pay tax. And so that's what we're going to talk about here. If you claim depreciation on your home after May 6, 1997, you must recover depreciation you claimed on your home to the extent of the amount of depreciation you claimed or your net gain, whichever is less. The good news for many homeowners is that depreciation claimed for business use of home prior to May 7, 1997 does not need to be recaptured. So let's just suppose you had someone who used their home as a rental home in years before 1997. Let's just say they purchased the home in 1980, they lived in it till 1990, then they rented it out for 5 years before they moved back into it, and during the 5 years that it was rented, they claimed depreciation. Well, the IRS says you don't have to recapture that depreciation. The depreciation would reduce your basis in the home, but you don't have to recapture it and pay tax on it because the depreciation was claimed before May 7, 1997. But if you have any business use of the home after May 6, 1997, and you claim depreciation on the home, then that depreciation does have to be recaptured or recovered on the sale of the home, and it can create a taxable event. So here is an illustration where recapture of depreciation on the sale of a home creates a taxable situation. Chloe Sullivan sold her home on June 30, 2012 for $165,000. Chloe used her home for business and claimed allowable depreciation deductions on her home totaling $4,000. Chloe's adjusted basis in her home is $100,000, and she purchased her home on October 10, 2006. Chloe must recover depreciation she claimed after May 6, 1997. Depreciation she claimed after May 6, 1997 is reported on Schedule D on line 19. We need to complete Form 8949 and Schedule D for Chloe as shown on the next 2 pages. So we return to this 8949, and again we enter the description on line 3, main home, date acquired, date sold, proceeds from the sale or the sales price, and then we enter the cost or other basis. And then in column F, we enter code H for claiming the exclusion on the sale of home, and then we enter the amount of the adjustment. And in this case, the amount of the adjustment is less than her gain. Her gain, she sells for $165 and pays $100. Her gain is $65, but she cannot exclude the gain that is attributable to recovery of this depreciation of $4,000. So she subtracts $4,000 from the exclusion amount she's allowed, and she enters the net total, which is $61,000. And then in column H, she will enter the taxable portion of her gain. Now, the deal with this $4,000 is because it is a recovery of depreciation, it creates a need to treat this gain a little bit differently than other forms of capital gain. And that's because this particular gain is subject to a maximum tax rate of 25% rather than a maximum rate of 15% for 2012. We move over to the Schedule D, and on the Schedule D, we just carry those totals from 8949, sales price $165, cost basis $100, exclusion amount $61, taxable profit $4,000. And then when we get over to page 2 of Schedule D, we're asked to enter on line 19 what portion of the gain is from a recapture of Section 1250. And 1250 gain is recovery of depreciation on real estate. It's a very specific type of recovery, and whenever you have a recovery under Section 1250, you do need to make an entry for that on line 19 of Schedule D. And then, of course, the final step is to put that $4,000 on line 13 as capital gain income. And when it comes time to calculate her tax, Chloe's going to have to do a Schedule D worksheet to figure out what the rate of tax is that she owes on that $4,000. Sale of home used for business is the next topic. Now, in the earlier example, we showed how Chloe had a home. It wasn't currently being used for business. She just had used it for business sometime in the past. And because she sold it and it had been used for business, she had some depreciation that she claimed, and we needed to recover that depreciation and include it as taxable income. But there's other ways that you can sell a home that's used for business, and one of those is maybe at the time you sell it, you're still using it for business. And is that going to affect things? Are you going to have to pay tax on the profit from the sale because part of the home was used for business and part of the home wasn't used for business? It seems logical that you should have to do that, but the reality is that usually you don't. The only thing you're normally going to have to do is recover depreciation. But there can be a situation where gain on the sale of your home is partially taxable. Usually that only occurs when you've got your two separate structures or two separate parts of your home rather than just a room in your home or a part of your home being used. So we'll talk about each of those in turn. If you use property partly as a home and partly for business or to produce rental income, the treatment of any gain on the sale depends partly on whether the business or rental part of the property is a part of your home or separate from it. So let's look first where we have part of the home that is used for business or rental. If the part of your property used for business or to produce rental income is within your home, such as a room used as a home office for business, or maybe perhaps you rented a room in your home, you should apply the following rules when you sell your main home, which was partially used for business. You do not need to allocate the basis of the property and the amount of the profit realized from the sale between your business part of your property and the part used as your home. Also, you do not report the sale of the business part or rental part on Form 4797. This is true whether or not you were entitled to claim any depreciation. Also, you must recover and pay tax on any part of the gain equal to any depreciation deductions that were allowed or allowable after May 6, 1997. And you'll notice it says allowed or allowable, and what that means is, let's just suppose you had a home that was subject to depreciation because it had business use, but you didn't claim the depreciation. Have you ever seen that happen? I see it happen all the time. People are supposed to claim depreciation and don't, or they claim the wrong amount of depreciation. When it comes time to sell an asset that should have been depreciated, you have to recover that depreciation or recapture that depreciation regardless of whether you actually did claim depreciation. We cover all of that in our course called Sale of Assets. We get into it more there and also in a little bit under Depreciation Made Easy. So let's look at an example where we might have a partial exclusion of gain. Ray sold his home, his main home, in 2012 at a $30,000 gain. He meets the ownership and use test to exclude the gain from his income. However, he used part of the home as a business office in 2011 and claimed $500 of depreciation. Because the business office was part of his home and not separate from it, he does not have to allocate the basis and amount realized between the business part of the property and the part that was used as a home. Instead, he reports his gain, exclusion, and taxable gain of $4,500 on Form 8949 and on Schedule D. He also reports the recovery of depreciation amount on Schedule D on line 19, as I showed you earlier with Chloe, that line 19 number, and on Form 1040, line 13. So ultimately, he's going to report the sale of his home, and the reason he's reporting the sale, let's just assume he didn't even get a 1099-F. He's reporting the sale on 8949 and Schedule D because he claimed $500 of depreciation after May 6, 1997. So he completes the 8949. He shows the cost basis. He shows the sales price. He figures what his gain is. He excludes his gain except for the $500 that was for depreciation, and then that $500 becomes taxable income. Example number 2, we have a full exclusion of gain. The facts are the same as in example 1, except that Ray was not entitled to claim any depreciation deductions for the business use of his home, and since he did not claim any depreciation deductions, he can exclude the entire $30,000 gain. Separate part of property used for business or rental. You may have used part of your property as your home and then a separate part of it for business or to produce rental income. Examples of separate part of property include a working farm on which your house was located, an apartment building in which you live in one unit and rented the others, and a store building with an upstairs apartment in which you lived. Use test not met for the business part. You cannot exclude gain on the separate part of your property used for business or to produce rental income unless you owned and lived in that part of your property for at least 2 years during the 5-year period ending on the date of sale. If you do not meet the use test for the business or rental part of the property, you must allocate the basis of the property and the amount realized upon its sale between the business or rental part and the part that was used as a home. And here's an example of how that would work, where we have gain on the separate part of the property is taxable. Jessica is self-employed and lives in a duplex that she owns. Jessica lives in the larger duplex, which is 60% of the building, and then she runs her business from the smaller duplex, which is 40% of the building. Jessica has owned and occupied her duplex for the past 4 years, and she has operated her business from the duplex for the last 4 years as well. Jessica sold her home in 2012. She can exclude the gain only on the 60% portion of the duplex that was her home. She will need to report any gain or loss on the sale of the business use portion of the duplex that was used for her business. So assume that Jessica paid $200,000 for her home and then she sold it for $300,000. That means she has a $100,000 profit or gain. 60% of that gain is not going to be taxable. She's going to be able to exclude it from her income because it's attributable to the personal use portion of her property. But the other portion of the property that was used for business, that 40% portion, results in $40,000 of taxable gain. In addition, we have to assume that if she was doing her taxes correctly, she was figuring depreciation and claiming depreciation each year, and any amount of depreciation that she claimed after May 6, 1997 is also going to be taxable and add to the amount of income that she has to report. Now here's another topic, which is something to be paying attention to. It's really a total change in strategy in the last few years over the strategy people had for a long time. Back, if you recall, in 1997, when the exclusion rules came into play, a tax planning strategy was, okay, I own some rental properties. What I can do is I can move into a rental property that I've owned, maybe even for 20 years. And if I live in that property for 2 years, then I can sell it and I'm not going to have to pay any tax on the gain except depreciation claimed after May 7, 1997. And so that strategy worked fairly well for a number of years, but it was a loophole that was closed back in 2008. The reason it's closed is a fundraising measure to help fund some other tax breaks that have come into play since Obama came into office. So there's some rules now that say if the government wants to fund a particular tax benefit, they're going to have to figure out where the money's going to come from. And so one of the things they did is they closed this loophole because that was going to generate some money for other things. So that loophole is now gone, but it's only gone for non-qualified use after 2008. So what is non-qualified use? Generally, non-qualified use means any period in 2009 or later where neither you or your spouse or your former spouse used the property as a main home. A period of non-qualified use, however, does not include any portion of the 5-year period ending on the date of the sale or exchange that is after the last date you or your spouse used the property as a main home. So what that's saying is you have to own and occupy the house 2 out of 5 years. If you move out of the house and do not live in it for the last 2 years, well, that 2 years of use is after the qualifying use, and so it's not non-qualified use. In other words, you wouldn't have to treat the 2 years you rented it after you moved out as business use. On the other hand, if you moved out of the house in the first 2 years and then moved into the house for 3 years and then sold it, in both those situations, you occupied the house for 2 out of 5 years. But the second situation, the occupation is before the last time you lived in the home as opposed to following the last time you lived in the home. So when we're looking at non-qualified use includes use that occurs before you move out, but not use that occurs after you move out if it falls in the parameters of item number 1 here. So item number 1 is any portion of the 5-year period ending on the date of sale or exchange that is after the last date you or your spouse used the property as your home. Number 2, another reason that you would not have a non-qualified use is any period not to exceed the aggregate period of 10 years during which you or your spouse is serving on qualified official extended duty as a member of the Uniformed Services, as a member of the Foreign Service of the United States, or as an employee of the intelligence community, and any other period of temporary absence not to exceed an aggregate period of 2 years that is due to a change of employment, health conditions, or other such unforeseen circumstances as may be specified by the IRS. So item number 3 is kind of a little bit up in the air. You might have a situation where a person accepted a job somewhere else, and so they rent their home, and then the other job ends and they come back. Is that going to be a qualified reason for a temporary absence? And you're going to have to look at all the facts and circumstances to see if it would qualify as a period of qualified use, even though it is before a period that they last lived in the house. Allocating gain on sale between qualified and non-qualified periods of use. Well, ever since this 2008 rule came into effect, or post-2008 rule came into effect, there's been a fairly complicated calculation that has to go on. And if you read the IRS publication 523 on sale of home, you'll see some illustrations in there. And I've gone ahead and created another illustration utilizing information they're providing to show you or explain how it all works. But if you're still a little fuzzy after I show you my illustration, by all means return to the IRS publication on sale of home and read some of the additional illustrations that are in there to help clarify it. To figure the portion of a gain that is allocated to the period of non-qualified use after 2008, multiply the gain by the following fraction. Total non-qualified use during the period of ownership in 2009 or later over the total period of ownership. So this is the formula. Take the total non-qualified use and divide that by the total period of ownership. And here's an example where we end up applying that formula, but we have a fully excludable gain. William owned and used a home as his main home from 2006 through 2009. On January 1, 2010, he moved to another state. He rented his home from that date until April 30th, 2012, when he sold it. During the 5-year period ending on the date of sale, which is May 1, 2007 through April 30, 2012, William owned and lived in the house for more than 2 years. So let's look at the 5-year period. We have a period of use in the 5-year period, the final 5 years of ownership, that 2 out of 5 year rule. We can look at when he used it as his main home, and it's a total of 44 months, and it's all before the period that it was used as a rental. So we have 44 months of personal use followed by 27 months of business use. So although the home was used as a rental, all rental use after 2008 was also after the last time William lived in the home and used it as his main home. Since the home was a rental time at the time of sale, William does need to report the sale on Form 4797. However, because the period of non-qualified use does not include any part of the 5-year period after the last date that William lived in the home, he has no period of non-qualified use. And because he met the ownership and use test, he can exclude the gain up to $250,000, but of course he cannot exclude any part of the gain that is equal to depreciation he could have claimed or did claim while renting the house. Let's compare William's illustration to another illustration where we end up with a partially taxable gain. This illustration involves a character named June Cleaver, and she is single. She bought her home back on May 1, 2002 and lived in the home until December 31, 2010, when she moved out and rented it out. June rented her house until December 31, 2011, and then she moved back into it and lived there until she sold it in 2012. She owned the home for a total of 3,684 days. Now, June can exclude the gain on the sale of her home because she owned and lived in the home for at least 2 years of the 5-year period ending on the date of the sale. However, her exclusion will be prorated based on the total number of months she lived in the home and the total number of months the home was used as a rental after 2008. So we're going to use June's records to show the following. We have a purchase price of $100,000. She paid title search of $500. She also paid back taxes for the prior owner when she bought it of $1,500, and these are all going to add to her basis. She also made improvements to the home costing $10,000, which is another addition to basis. She sold the home for $270,000, and she had selling expenses, including commission, of $18,000, and she had depreciation after May 6, 1997 of $3,345. So then we look over at this table to see how all of the days of use are going to work out and when the days of use are. You can see here that she lives in the home from June 1st, 2007 through December 31, 2010, a total of 43 months. She then moves out for 12 months, and then she moves back in for 5 months. So you can see that the total months used is 48 months, and the total months of rental is 12 months. But the problem is that these 12 months precede a period of time where she lived in the home. They do not all follow it. Because they don't all follow it, she's going to have a partially taxable gain. The IRS provides 3 worksheets which are used to figure the taxable gain from the sale of the home. We use worksheet 1 to figure the adjusted basis of the home she sold. And the weird thing is, in this calculation, all of the selling expenses are going to add to her cost. In the earlier example with Betty and Peter Homemaker, IRS said don't take the selling expenses and add those to cost, enter those as an adjustment. But in this illustration, they're saying do take the closing costs and add them to basis. So they've got it going two different ways there, which adds to the confusion. So the purchase price is $100,000, title search $500, back taxes paid for the prior owner $1,500, improvements. So the basis before we claim depreciation is $112,000. We then subtract out depreciation and we get an adjusted basis to the home of $108,655. And IRS has a worksheet to figure all of these calculations. You can see when we get onto line 13 of the worksheet, we've got that same number, $108,655, and the worksheet is just guiding you through those three steps. The cost of the home, legal fees paid on the home, amounts that the seller paid for the buyer on purchase. Those are increases to basis. The improvements are increased to basis. This is the basis before depreciation. We then take depreciation and we end up with the total adjusted basis. So that's worksheet 1. We then move over to worksheet 2, and worksheet 2 is divided into two parts. And the first part says, okay, figure out what the gain on the sale is. We take the sales price of the home, we subtract out the expenses of the sale, we subtract out the adjusted basis of this home to get the gain from the sale. And so these three steps are all summarized here. You get down to line 5, $143,345. We then go over to part 2 of worksheet 2. And this time we figure the gain without depreciation. So on line 5 of the worksheet, we figure that the gain including depreciation is $143,000. We then go over and say what portion of the gain was depreciation. We pull that out and we end up with a number. $140,000 is the amount of gain that the taxpayer would have had if no depreciation had ever been claimed, $140,000. We then do the formula that says take the total number of days that the house was rented after 2008, that's 365 days, and divide that by the total number of days that June owned the home, 3683. When we do that, we get 0.099, or 9.9%. The next step is to take that 9.9% and multiply that by the gain of 140, and that's what happens here. We end up with 13,860. So 13,860 of the gain is taxable income to June because it is attributable to non-qualified use after 2008. And then we have to subtract that taxable gain from the total gain of 140 to get the amount of gain that June will be able to exclude from her income. So when she goes to fill out the Schedule B and the Form 8949, on the Form 8949, she's going to need to enter an exclusion amount, and this is it. So we had to go through all of those steps to get to this number, $126,140, and she's going to enter that in column G of Form 8949. She's then going to go over to figure how much of the total gain she has that's going to get taxed. And the total gain that's going to get taxed is comprised of two parts. One is the gain attributable to the non-qualified use, and the other is the gain attributable to recovery of depreciation that has been claimed after May 6, 1997. So we take the depreciation, we add the taxable gain, and we've got the total taxable amount for June on her tax return. So then we go over to part 2 of the worksheet, and all of these numbers flow through in exactly the same way. We enter the maximum exclusion amount she could be entitled to, $250,000. We also look at the amount of depreciation she could claim. We look at the total gain on the sale of the home. We look at the number of days of non-qualified use. We look at the number of days the taxpayer owned the property. And you can see these are slightly off on the number of days simply because there's a leap year in here that's kind of thrown off our calculations a little, but ultimately it doesn't matter because we end up with the same excludable amount of $13,860. And then we end up with the number that she's going to be able to exclude, the $126,140. So this worksheet, worksheet number 2, part 2, is going through all of the calculations I just showed you here kind of descriptively. And when you get to that $126,140 of gain that she does not have to pay tax on, you carry that down to the 8949 and you enter it in column G. And then in column F, you enter code H. That means that she's claiming the exclusion for living in the home 2 out of the last 5 years. And of course, the amount of gain that she is going to get taxed on is that $17,205, this number right here. But that number itself needs to be divided into two parts, the amount that's a depreciation recovery and the amount that's pure capital gain. Why do we have to do that? Well, the rate of tax on recovery of depreciation is potentially higher than the rate of tax on the other portion of the capital gain. So we get over to the Schedule D next. And all of the numbers that appear across this bottom line of the 8949, line 4, you see 270, 126, 655, 126, 140, and 17205. Those are going to carry over to line 10 of the Schedule D. And on line 10 of the Schedule D, we enter that total taxable gain. We then move over to page 2 of the Schedule D. We continue with that taxable gain, and then on line 19, we show what portion of the gain is due to recovery of depreciation. And ultimately, June is going to need to complete a Schedule D worksheet to figure out how much tax she owes on the combined capital gain income, $17,205, of which $3,345 is recovery of depreciation. So recapturing or paying back a federal mortgage subsidy is the next topic of the day. And the recapturing or paying back of a federal mortgage subsidy is not something that comes up terribly often. I can't think of any time I've ever even had to deal with it. It's because people take advantage of these mortgage subsidies so rarely. But if you do have a client who did benefit from them, there are some special rules that you need to be aware of. If you financed your home under a federally subsidized program, including loans from tax-exempt qualified mortgage bonds or loans from mortgage credit certificates, then you may have to recapture all or a part of the benefit you received from the program when you sell or otherwise dispose of your home. You recapture the benefit by increasing your federal income tax for the year of the sale. You may have to pay this recapture tax even if you can exclude your gain from your income under the rules discussed earlier. That exclusion does not affect the recapture tax. The recapture tax applies to loans that come from proceeds of qualified mortgage bonds or were based on mortgage credit certificates. The recapture also applies to assumptions of these loans. So when does the recapture apply? Recapture of the federal mortgage subsidy applies only if you meet both of the following conditions. Number one, you sell or otherwise dispose of your home at a gain or a profit within the first 9 years after the date you close on the mortgage loan. And your income from the year of disposition is more than that year's adjusted qualifying income for your family size for that year related to the income requirements a person must meet to qualify for the federally subsidized program. So what they're saying is you first look, did they live in the house for fewer than 9 years? If they did, then you look to their income. Is their income above the threshold amount for their family size for that year? If they meet both of these requirements, then the recapture will apply. If they do not meet either of the requirements, then the recapture would not apply. Other reasons why the recapture does not apply. Your mortgage loan was a qualified home improvement loan, or QHIL, of not more than $15,000 that was used for alterations, repairs, and improvements that protect or improve the basic livability or energy efficiency of your home. Or your mortgage loan was a QHIL, QHIL, of not more than $150,000 in the case of a QHIL used to repair damage from Hurricane Katrina to homes in the hurricane disaster area as well as Gulf Opportunity area and Wilma Go Zone area. Or the home was disposed of as a result of your death. Or you disposed of the home for more than 9 years after the date you closed on your mortgage loan. Or you transfer the home to your spouse or your former spouse incident to a divorce where no gain is included in your income. You dispose of the home at a loss. Your home is destroyed by a casualty and you replace it on its original site within 2 years after the end of the tax year when the destruction happened. The replacement period is extended for main homes destroyed in a federally declared disaster area, a Midwestern disaster area, and the Kansas disaster area. You refinance your mortgage loan unless you later meet the conditions listed previously under when recapture applies. So those are all reasons why you wouldn't have to recapture the mortgage subsidy. Notice of amounts. At or near the time of settlement of your mortgage loan, you should receive a notice that provides the federal subsidized amount and other information you will need to figure your recapture of the tax. And if you are subject to recapture of the tax, then you need to complete Form 8828 to figure the amount of the recapture and enter it on your return. And here is Form 8828, Recapture of Federal Mortgage Subsidy. Never had to fill it out, so don't ask me how. It seems to be that this topic comes up in every other course I teach, but I try to put it wherever it's relevant. And of course, sale of home, you can't help but talk about the recapture of the first-time homebuyer credits. There are 3 different homebuyer credits that were available to certain first-time homebuyers and certain long-term homeowners during tax years 2008, 9, 10, and 11. Some individuals who claimed these credits are required to pay back some or all of their credits in certain situations. And interestingly, when we got to tax season 2013, I kind of thought, when we might be entering an era where maybe people wouldn't have to be repaying any of their home credits, and yet our company had at least 2 clients who had to repay some or all of their mortgage credit because they ended up in a disqualifying situation. So for 2012 tax year, it was certainly relevant, but each year we go into the future, it'll be less and less relevant, except for those people who fall under the 2008 rules. And why is 2008 special? Well, if you claimed the credit for a home that you bought in 2008, you generally have to begin repaying your credit that you received, which was $7,500, starting with your 2010 return. And the way that credit works is 2008, you filed a return, you purchased a first home, you claimed a $7,500 credit, but that credit was in the essence a loan that had to be repaid interest-free over a period of 15 years beginning in 2010. And so what happens is every year until that house is either sold or the 15 years has elapsed, we're going to be dealing with this recapture amount of $500 each and every year as an additional tax on the 1040. Now, you may be required to pay more than $500 in 2012 if you claimed the homebuyer credit for a home you bought in 2008 and then you sold the home in 2012, or the home stopped being your main home in 2012. Repayment of the homebuyer credit claimed for 9, 10, or 11. You must repay some or all of the homebuyer credit you claimed for 2009, 10, or 11 if you disposed of or ceased using as your main home the home for which you claimed the credit within 36 months of the date of purchase, and any of the following situations apply. You sold, including through foreclosure or repossession, the home to a person who is not related to you and you had a gain on the sale. But if you sell the home to a person who is not related to you, the repayment in the year of sale is limited to the amount of gain on the sale. The amount of credit in excess of gain does not have to be repaid. Or if you sold the home at a loss, you wouldn't have to repay any of it. You sold the home to a related person. That would cause you to have to do a recapture. You converted the entire home to rental or business use, or you still own the home but no longer use it as your main home. Well, it's this point 3 and 4 that I ran into with clients of our company this past year. One client purchased a home as a long-term resident credit. Remember, for 2009, 10, we had a credit that was $8,000 if you purchased your first home, but if you'd owned a home for, I think it was 5 years or more, you could purchase a new home and claim a $6,500 credit. So I had one client who'd claimed that $6,500 credit to purchase a new home and move into it, and I had another client that took the $8,000 credit to buy his first home, and both of them had to repay these credits in 2012. The first one, they just didn't like the home, didn't want to live in it anymore, so they decided to rent it and buy another home again. And they seemed quite content with the fact that they had to repay that $6,500. Didn't bother them much at all. The second guy, he was a little more, well, he wasn't arguing about his fate. He realized what it was and he was stuck with it, but it all had to do with the divorce. And then in the divorce, the wife took other things and left him the house. And he was left with the house, but without her income and all of the child support he had to pay as a consequence of the divorce, he could no longer afford to live in it. And the market was really bad, so he couldn't sell it either. So he decided to rent it out to help compensate for some of the overhead of maintaining this house. And as a result, he had to recapture his credit. And finally, your home was destroyed, condemned, or disposed of under threat of condemnation, and you did not plan to acquire a new home within 2 years of that event. That would be a reason why you have another recapture. To determine how much of your credit you must repay, complete Form 5405. Now, no repayment of the credit is required if any of the following exceptions apply. Number 1, your home ceased to be your main home because you or your spouse, if married, was a member of the Uniformed Services or the Foreign Service or an employee of the intelligence community, and you received government orders to serve on qualified official extended duty. You sold, including through foreclosure or repossession, the home to a person who is not related to you and you did not have a gain. You transferred the home to your spouse or ex-spouse as part of a divorce settlement. Then the responsibility for repayment of the credit is transferred to the spouse or ex-spouse. And if none of the allowed exceptions apply and your ex-spouse or spouse sells the home or it ceases to be his or her main home during that 36-month period, then he or she is responsible for repaying the credit. Or your home is destroyed, condemned, or disposed of under threat of condemnation, but in that situation, you do not have to repay the credit only if you bought another home within 2 years. And the taxpayer who claimed the credit died in 2012. That's another reason why you don't have to repay it. And finally, you die. But if you claim the credit on a joint return and then you die, your surviving spouse would be required to repay his or her half of the credit if during the 36-month period beginning on the purchase date he or she disposes of the home or it ceases to be his or her main home, and none of the following exceptions apply. So how do you go about repaying the credit? If you received the 2008, 9, 10, or 11 homebuyer credit when you purchased your home, you may have to recapture part or all of the amount received. For 2008 first-time homebuyers, this is creating a taxable event each and every year for 15 years after 2010, or until they sell the home, whichever date comes earlier. So let's look at an example of how that would work. And I decided to use, a long time ago when I recreated this illustration, I decided to use the 2008 credit because I feel it's going to be the one that's around the longest, but the rules for filling the form out that you see here are going to be the same if any of those other credit situations apply. So here is our example. Johnny sold too soon received the $7,500 2008 first-time homebuyer credit. He purchased his home on July 1, 2008 for $250,000. His adjusted basis in the home is $242,500 because you take the purchase price and in all of the credits, you reduce the basis in the home by the amount of credit claimed. In this case, $250 minus $7,500 gives him $242,500. Johnny repaid $1,000 of the credit with his 2010 and 11 returns, and then he sold the home in 2012 for $253,000. Well, $253,000 is more than he paid, and it's more than his adjusted basis. So let's see how it all works out. Purchase price of the home, $250,000. Subtract out the first-time homebuyer credit, but add back in the amount of first-time homebuyer credit that he has already repaid, and we get an adjusted basis in the home of $243,500. We then take the sales price, subtract out selling expenses of $4,500. Take the adjusted basis as another subtraction, and we're left with a total profit on the sale of $5,000. The form has all of this formula essentially worked into it, starting with the sales price of the house, taking selling expenses, taking the adjusted basis of the home, doing the numbers a little bit differently because the adjusted basis in this situation is not accounting for anything other than the selling expenses. So it's done a little bit differently. And we get $250,000, and then we subtract out how much of the first-time homebuyer credit has not yet been repaid. Either way you do it, you get the same result, $5,000. So the worksheet built into the form does the formula a little bit differently, but the whole point is you're trying to figure out what the taxable gain is. Both of these different calculations get you to the same place, $5,000. That $5,000 that is figured on the form carries down to line 59B of Form 1040 and is entered as a tax owed. Subspace, S-U-B-S-P-A-C-E, subspace. All right, everyone, we are going to be talking about installment sales. As an introduction, when you sell an asset at a gain, the gain is usually taxable in the year of the sale. But if the sale price is paid for over time in installments, then the taxable gain can be spread over 2 or more years based upon the payment received in years following the year of sale. An installment sale is a sale of property where you receive at least one payment after the tax year of the sale. What's interesting about the installment sale rules is that they are basically mandatory unless you elect out of them. So in other words, you default to the installment method unless you elect to get out of it. However, the installment sale rules do not apply to the following: the regular sale of inventory, or stock or securities traded on an established market, or to the sale of property that is sold at a loss. So let's look to the general rules. If a sale qualifies as an installment sale, the gain must be reported under the installment method unless you elect not to use the installment method or the property sold does not qualify for the installment method. Figuring installment income. Each payment on an installment sale usually consists of 3 parts. The first is interest, and interest is always assumed to be in every payment. You can't have an installment sale without interest. As far as the IRS is concerned, there's always an interest component. And then there is also a component that is a return of your adjusted basis or your cost in the item that has been sold. And then finally, there is the profit from the sale, and part of each payment is going to be allocable to basis, and part of each payment is going to be allocable to profit. For each year that you receive a payment on the sale of your property, you must include the interest part in your income. as well as the part that is your gain on the sale. You do not include in income the part that is a return of your basis in the property. So we have the interest part component up here, and then we have a second component that includes both the return of basis and the gain on the sale. Firstly, the interest part. You must report interest as ordinary income. Interest is generally not included in a down payment. However, you normally would treat part of each later payment as interest, even if it is not called interest in your agreement with the buyer. So essentially, if you have a client that comes to you and they have an installment contract, they may or may not have figured or deduced that interest is a part of that contract. Lots of people aren't aware that they have to do that type of calculation, and they think that either interest doesn't apply or that they aren't forced to have interest, or if they do think interest applies, they're not sure exactly how to calculate it. So one of the beauties of the modern internet age is it isn't hard to find amortization schedules on the internet. If you just type amortization schedule in your Google search engine, you're going to come up with 2 or 3 to choose from that are free right away. And in there you would enter the contract price, you would enter the monthly payment and the interest rate. And then it can produce for you a schedule that shows the portion of each payment that is interest, the portion of each payment that is principal, and then you will use that information to complete the installment sale form when the time comes. I have had, I think, 1 or 2 clients over the years involved in installment sales that bring me their amortization schedule already completed, but most of the time it's something that I do for them. In the first year, I figure their installment sale. I get that amortization schedule, I print it or I save it as a file in my computer, and I use it from that point forward. But the bottom line is there's always a component of interest, and it needs to be a fair market rate of interest. Right now, if you sell real estate, it would be fair to have a minimum interest rate of 3.5% to 4.5%. It could be higher because very often installment sales, one of the benefits to the seller of an installment sale is that they can charge a little bit more than a bank because they're absorbing maybe a buyer that a bank wouldn't fund. But they need to have at least that minimum reasonable amount. And then part of each payment is the return of basis and gain on the sale. Now, an amortization schedule is not going to show you the gain on the sale. It's only going to show you the part of each payment that's principal and the part of each payment that is interest. And of the part that is principal, part is going to be for basis and part is going to be for the gain on the sale. So the rest of each payment is treated as if it was made of 2 parts. One part is a tax-free return of your adjusted basis, and the other part is your gain, presumably your capital gain. How to figure the gain on the part of your payment. To figure out what part of any payment is gain, multiply the payment less interest by the gross profit percentage. Use the following worksheet to figure the gross profit percentage. And of course, this worksheet comes straight out of the IRS instructions. It's got their little pencil mark there. You should recognize it. Also, I should point out that this particular worksheet or this particular formula, at least here in the state of Oregon where we have a higher level exam for tax consultants, this is a formula that tax consultants in this state are tested on. If you are studying for the enrolled agent exam, I've looked at prior questions from the enrolled agents exam, and I don't know that it asks for the calculation. I haven't seen an example where it does ask for the calculation, but it certainly asks what the formula is, even if it doesn't ask you to compute it. So it's important to understand what the formula is, and for anyone in the state of Oregon who's studying for the consultant exam, this is a frequently missed topic or a most frequently missed topic where people usually get it wrong, so you should pay close attention. So the worksheet says you start with the selling price of the property. You then enter your adjusted basis in the property, and then you enter your selling expenses. Then you enter any depreciation recapture, and you add those amounts up. And when you've done that, you get something called your adjusted basis for installment sale purposes that's entered on line 5. You then subtract line 5 from line 1, and if you get a number that's 0 or less, you stop. You would stop because you don't have a profit. And if you don't have a profit, then you don't have an installment sale per se. You have to have a positive number. And if you do, then you can have an installment sale. Then on line 7, you enter the contract price for the property, and you divide line 6 by line 7 to get the gross profit percentage. So this worksheet is used to figure the gross profit percentage, and then that gross profit percentage is entered on the installment sale form, and it applies to all future payments. Let's start first with what the form is asking you for. So on here on line 1, it says enter the selling price of the property. What does the IRS mean by that? Well, the selling price is the total cost of the property to the buyer. It includes any money, the fair market value of any property you are to receive, any debt that the buyer assumes or pays for the property sold, and any selling expenses that the buyer pays for the seller. The selling price does not include interest, whether stated or unstated. Installment sale basis. That's line 2. 3 items comprise installment sale basis: adjusted basis, selling expenses, and depreciation recaptured. 2, 3, and 4 all combined. You must figure your installment sale basis before you can calculate your gross profit percentage. And the next one is the contract price. You can see here it's saying enter the contract price on line 7. What is that? Well, contract price equals the selling price minus the mortgages, debts, and other liabilities assumed or taken by the buyer, plus the amount by which the mortgages, debts, and other liabilities assumed or taken by the buyer exceed your adjusted basis for installment sale purposes. And finally, the gross profit percentage. Your gross profit percentage is the amount of each payment that is to be reported as a gain from the sale. The gross profit percentage generally remains the same for each payment you receive. However, if you agree to reduce the selling price at a later time, you will have to refigure your gross profit percentage for the remaining payments. So how would that work? Let's just suppose you have an installment contract and you agreed to sell a piece of property for $100,000 on installment. 3 years into the contract, the buyer comes to you and says, hey, you know what, I'm going to default and let you take this back because property values have dropped and I can't be bothered with it anymore. The only way I'm going to stay in this contract is if you agree to reduce the price. And if that were to happen and you agreed to it, then you would have to refigure your gross profit percentage for the remaining payments. Next, let's take a look at how you go about reporting an installment sale. And when you report an installment sale, you use IRS Form 6252. You use Form 6252, Installment Sale Income, to report an installment sale in the year of the sale and to report payments received in later years. Attach the form to your return each year that you receive a payment. Form 6252 will help you determine the gross profit, contract price, and gross profit percentage, as well as how much of each payment received during the year you should include in income. Form 6252 is divided into the following parts. Part 1 is used to figure the gross profit and the contract price, and it is completed in the year of the sale. Part 2 is used to figure the income from the installment sale. Part 2 is completed for the year of sale and for any year you received a payment or are treated or considered to have received a payment. And then Part 3 is filled out if you sold the property to a related person. Reporting requirements for the year of sale. You answer the questions at the beginning of the form and complete Part 1 and Part 2. Line 3 of the form asks you if you sold the property to a related person. If you answer yes, then you have to go and complete Part 3. Reporting requirements for later years. You answer the questions at the beginning of the form and complete Part 2 for each year in which you receive a payment on the sale. Payments received, including payments that are considered received. You must figure your gain each year on the payments you receive or are treated as receiving from an installment sale. These payments include the down payment and each later payment of principal on the buyer's debt to you. In certain situations, you are considered to have received a payment even though the buyer does not pay you directly. This occurs if the buyer assumes or pays any of your debts, for example, mortgages or taxes owed, or pays any of your expenses, for example, sales commissions. Seller financed mortgage. Special reporting requirements apply if you finance the sale of your home to an individual. When you report interest income received from a buyer who uses the property as a personal residence, write that buyer's name, address, and social security number on line 1 of Schedule B of your Form 1040 or 1040A, and I'll show you what I mean by that in just a minute. Schedule D is used to report the sale of personal property. If your installment property was held long-term, enter the gain figured on Form 6252, line 26, onto Schedule D, line 10, as a long-term capital gain. If your gain from the installment sale qualifies for long-term capital gain treatment in the year of sale, it will continue to qualify for long-term treatment in all later years. Your gain is long-term if you own the property for more than a year when you sold it. If you held it short-term, you would enter it on line 4 of Schedule D, and long-term is line 10 of Schedule D. Detailed illustration of how all of this comes together, because that's always the best way to learn. We have a character in our story named Sally Sale, and she has sold her vacation home on June 30, 2012 for $350,000. She paid $5,000 in selling expenses. And because this is a sale of a home that is not her main home, she's not going to be entitled to exclude any of the gain. She's got a taxable gain, and she wants to use the installment method on it. Now, she purchased the home back in 2002 for $150,000, and she claimed $2,000 of depreciation on the home in prior years. Sally received $1,800 in payments for the year, of which $12,000 was applied to the principal amount of the loan and $6,000 was applied to interest. Sally's W-2 is shown below. You can see it shows $50,000 of W-2 income, and we would like you to prepare her tax return. Now, to complete Sally's return, you need to begin by preparing her 6252 to calculate the income from the installment sale. You'll then carry the taxable gain to the Schedule D and then on to the 1040, and we'll actually show you how to calculate the tax as well. So here is a 6252 all filled out for Sally, and you can see I've got colored boxes on the side here, and each of these colored boxes corresponds to an area highlighted on the form and points out the things that I think are the most important. Now, on lines 1 through 4 in this first section, you need to provide information describing the property that was sold and the date of purchase and sale. You then answer the related party questions on line 3 and 4 that you see right here, and in this case we're saying that Sally did not sell to a related person. Then on line 5, we begin by entering the sales price. On line 6, if a mortgage was assumed, we would enter the amount of assumed mortgage, and of course any amount on line 6 is going to be added to any of the payments received to arrive at the amount to enter on line 5. But since there's 0 on line 6, we just leave it blank and move to line 7. And line 7 is of course the same as line 5 because 6 is 0. We then enter the cost or other basis of the property sold on line 8. Now line 9, we've highlighted in a bluish color. It kind of stands out because it wants you to enter depreciation that was allowed or allowable. Well, if you go in and read the instructions for Form 6252, it can be a little bit confusing about what's the difference between the amount you enter on line 9, depreciation allowed or allowable, and this other amount that you come down here on income recapture, line 12. Income recapture from Form 4797, Part 3. See the instructions. What's the difference between these two lines? Well, income recapture on Forms 4797 typically would affect Section 1245 property. Section 1245 property is personal property, property that is not real property, that has been sold at a gain, and the gain is attributable to prior depreciation claimed. And if you sell personal property, and I don't mean personal use property, I mean property is divided into two categories, real property and personal property is Section 1245 property. If you sold Section 1245 property, any depreciation you claimed over time is recaptured in the year of sale, and it's entered on line 12. But if you sold real property, which is Section 1250 property, any prior depreciation that was allowed or allowable is entered on line 9. And there's a big difference in how those two lines work for you. Line 9 is a much better deal than line 12. And in this case, Sally's sale has Section 1250 depreciation, and it's being entered on line 9. And it serves to reduce her basis from 150 down to 148. But she also had commissions that she paid on the sale of $5,000, so those add to her basis. So her basis is 150 minus 2 plus 5 equals 153. And then the next step for the orange section right here is rather elementary. Take line 5, subtract line 13, and you get line 14. This is the installment sale adjusted basis for the contract sales price on line 1. We subtract line 13 from line 5, and we get line 14, and then we carry line 14 to line 16, and this is basically the gross profit from the sale. So this is Sally's net profit. The sales price is $350. So what percentage is 197 of $350? Well, you do the ratio there, and you get 56.286%. So that is her gross profit ratio. She made a pretty good amount of money on that sale. And then the next step is to enter the payments that she received on that contract for the year, and the payment she received was $12,000. We multiply 12,000 by 286%, and we get $6,754. That is the taxable profit for the year. And we're going to then carry that amount to the Schedule D. So we go over to Schedule D, and we find the gain to enter from Form 6252, and we enter that $6,754. We then carry that down because there's no other entries on this particular Schedule D, and we get a net capital gain of $6,754. Now, there's more going on with the $6,754 than just saying, hey, I'm done with that. Part of that $6,754 profit is a recovery of depreciation, and whenever you're dealing with a recovery of depreciation, that recovery on Section 1250 property is subject to a higher rate of tax than other capital gain amounts. So of the gain, $2,000 is subject to a maximum tax rate of 25%, and the remaining $4,754 is going to be subject to a maximum rate of 15%. So let's see how all of that plays together for Sally. We go over to page 1 of her Form 1040, and we begin page 1 by entering her wage income. But remember, she had that interest payment on her installment sale as well. That buyer paid her $12,000 of principal payments, but they also paid her $6,000 of interest. And that interest is entered on line 8 of the 1040. It is ordinary income. And she also needs to complete Schedule B to report the interest income and the source of the payment. And in this case, the buyer is named Bob Buyer, and we have to enter his name, his social security number or other identification number, and then the address that he lives at. And so the Schedule B is attached to her return. The amount shown on the Schedule B corresponds to the amount on line 8A. And then on line 13, we enter the total capital gain that she had from the Schedule D. And we add those numbers up and we get adjusted gross income of $62,754. Next, we move over to page 2 of her 1040. And on that page, we start with her adjusted gross income. We're claiming a standard deduction. We're claiming a personal exemption. And we get to line 43 and we have her taxable income. Now, in most cases, taxable income of $53,004 is a small enough number you could just go over to the tax tables and look up Sally's tax. But because she has capital gain income, those tax tables are going to give her a rate of tax that's probably too high. So we don't use them. Instead, we take the number on line 43 and we carry that over to the Schedule D worksheet. We then use the worksheet to figure out what portion of the taxable income is attributable to capital gains. And that amount is $6,754. So we subtract the $6,754 out to figure out what her income is without the capital gain income. And that's $46,250. And the next step is to actually go to the tax tables. And let me just zoom in a little, maybe it'll be easier for you to read. The next step would be to go to the tax tables and look up the tax on $46,250. Instead of using the tax tables to look up the tax on $53,004. When you look up the tax in the tax tables on $46,250, you get $7,599. It happens to be that the formula also asks you to look up the tax in the tax tables on the $53,004, and there is an entry for that on this worksheet, but ultimately we don't use the number. The other steps we do on the worksheet are to figure out how much tax is owed on the $4,754 of capital gain that is not from a recovery of depreciation. And it's subject to a maximum rate of 15%. So we take 15% of $4,754 and we get $713. Then in the blue box, we enter the $2,000 of capital gain that is due to a Section 1250 recovery, and we multiply that by the maximum rate of 25%, and we get $500. Finally, we take these numbers, $713, $500, $75.99. We add those up and we get $8,812. Now, if we did go to the tax tables and look up the tax on $53,004, you can do that, and you have to as a part of this worksheet, you end up with $92.86. Well, $92.86 is more than the number on line 37, and so the difference between these two numbers is the amount of tax that Sally is saving because of the reduced capital gain rates. So we take $88.12, which is the final tax she does need to pay, and we enter that on line 44. And then the rest of the return is just showing her withholdings, and she ultimately owes $812. Let's move on to the next topic of the day, which is the buyer assumes a mortgage of the seller. Because there's space for that you saw on the 6252 and what happens when that happens. So here we go. You must figure your gain each year on payments you receive or are treated as receiving from an installment sale. And you are considered to have received a payment even though the buyer does not pay you directly. This happens, for example, when the buyer assumes or pays any of the seller's debts, such as a loan, or pays an expense for the seller, such as a sales commission. However, the buyer's assumption of the seller's debt is treated as a recovery of basis rather than a payment in many cases. Now let's look at what happens when this goes on. Firstly, the buyer pays the seller's expenses. If the buyer pays any of your expenses related to the sale of your property, it is considered a payment to you in the year of sale. Include these expenses in the selling and contract prices when figuring the gross profit percentage. What happens when the buyer assumes the mortgage? Well, if the buyer assumes or pays off your mortgage or otherwise takes the property subject to the mortgage, then the following rules apply. The first rule looks at whether the assumed mortgage is less than the basis. If the assumed mortgage is less than the basis, then you would follow the steps I'm about to explain. But if the assumed mortgage is greater than the basis, you would follow different rules, which I'll explain later. So in this first section here, we're going to talk about the mortgage that is assumed by the buyer from the seller or for the seller is less than the basis that the seller has. If the buyer assumes a mortgage that is not more than your installment sale basis in the property, it is not considered to be a payment to you. It is considered a recovery of your basis. The contract price is the selling price minus the mortgage. And here is an illustration where the buyer assumes a mortgage that is less than the basis. You sell property with an adjusted basis of $190,000. You have selling expenses of $10,000. The buyer assumes your existing mortgage of $150,000 and agrees to pay you $100,000, a cash down payment of $20,000 and $20,000 in each of the next 4 years. Thus, the sales price is the total of the assumed mortgage plus the installment amounts and equals $250,000. So they're going to pay you $100,000 in cash plus they're assuming the $150,000 mortgage. That means that the sales price of the property is $250,000. Since the buyer is assuming your mortgage, you must include the assumed mortgage and the selling price of your property. The contract price of the sale is equal to the cash payments received of $100,000. However, you must reduce your basis in the property by the amount of the assumed mortgage. And so you would follow these steps to complete 6252. And here we've got 6252. I'll zoom into it for you. And you can see that we begin on line 5 by entering $250,000. That is the selling price of the property. Then on line 6, we enter the amount of mortgage being assumed by the buyer, and that is subtracted out of the selling price to arrive at the amount of cash payments that the buyer is going to be making to the seller. We then look to the amount of the cost basis of the property, which was $190,000. And since we have commissions and expenses of the sale, those get entered on line 11. So we take line 9, which is the original cost basis, we add in the selling expenses, and we end up with a cost basis in the property of $200,000. And then we subtract that $200,000 from the $250,000 to get $50,000. And $50,000 ends up being the profit on the sale. And then we look at the amount of payments that are going to be paid to the seller, and those total $100,000. And so this formula is essentially giving a gross profit ratio of 50%. And what that means is that 50% of each payment is going to be profit. Payments received during the year were $20,000, and therefore the taxable part of the payments received is $10,000. So that's what you do when the mortgage assumed is less than the basis in the property. But if the mortgage assumed is more than the basis in the property, there's some different steps. If the buyer assumes a mortgage that is more than your installment basis in the property, you recover your entire basis. The part of the mortgage greater than your basis is treated as a payment received in the year of sale. To figure the contract price when the assumed mortgage is more than your basis, you begin by subtracting the mortgage from the sales price. This is the total amount other than interest that you will receive directly from the buyer. Add to this amount the payment that you are considered to have received, the difference between the mortgage and your installment sale basis. The contract price is then the same as your gross profit from the sale. So here's an illustration. The buyer assumes a mortgage that is greater than the basis. The selling price of your property is $90,000, and the buyer will pay you $10,000 annually plus 8% interest over the next 3 years, plus assume an existing mortgage of $60,000. Your adjusted basis in the property is $44,000, and you have selling expenses of $6,000 for a total installment basis of $50,000. The part of the mortgage that is more than your installment sale basis is $10,000. So the mortgage on the property is $60,000, but your basis in the property is only $50,000. That difference is $10,000. This amount is included in income in the year of sale. The amount is also included in the contract price and is treated as a payment in the year of sale. The contract price is $40,000 and is calculated as follows. So firstly, we go to figure the amount received from the installment sale. You begin with the selling price minus the mortgage assumed to arrive at the number that is actually received in payments over the life of the installment. You figure out how much of the assumed mortgage exceeds basis. Well, the assumed mortgage is 60, the basis is 50, the difference is 10. We then look at the mortgage in excess of basis. That's 10, and you add the amount that is actually received to get the contract price. We then figure the profit. To figure the profit, we take the selling price, we subtract out the basis in the property, and when we get to that, we end up with a gross profit of 40. Well, the contract price and the profit are both the same number. And whichever way you try to arrange the numbers, it's essentially designed in this formula to always give you a gross profit ratio of 100%, which means 100% of each payment you receive is taxable. And to the extent that the debt assumed exceeds your basis, you also have taxable income even though a payment wasn't received. So let's look at how all of these numbers fill out on the form. Firstly, we have the selling price of 90, and then we enter the amount of debt assumed, which is 60, to arrive at a net number on line 7 of 30. We then enter the original cost basis, and we add in the selling expenses, and we get 50. Well, 50 from 90 is 40, and then we look to see what the gross profit is. There's no other adjustments on line 15, so the gross profit from the sale is $40,000. Well, on line 17, it says subtract line 13 from line 6. So line 13 is this number right here, and line 6 is this number right here. So that's the amount by which the basis is less than the debt assumed, and that $10,000 number is entered on line 17. Then on line 18, you have your contract price, which is add line 7 and 17. Line 17 plus line 7 is that 40. So ultimately, the contract price and the gross profit are the same, and that gives you that gross profit ratio of 100%. And then it says, if this is the year of the sale, enter the amount from line 17. Well, what's the amount on line 17? That's the amount by which the basis is less than the mortgage assumed. And that difference is treated as income. It is entered on line 20. Then on line 21, we enter the actual amount of payments that were received, which is another 10. We add those two numbers together and we get 20. And so the taxable income from the sale for the year is 20. And of course, that would carry over to Schedule D and so on. Now, Form 4797 is another form that I'm not going to show you any illustrations that encompass 4797. We have an entire other class called Sale of Assets where we spend a lot of time on 4797, but I will briefly mention it here. An installment sale of property used for business or rent or for production of royalty income can result in a capital gain, an ordinary gain, or both. All or part of any gain from its disposition may be ordinary gain from depreciation recapture. You need to use Form 4797 to report these transactions and to determine the ordinary or capital gain or loss. So when you sell personal use property on an installment sale, like your home or your vacation home, you would fill out 6252 and carry the income from that sale to Schedule D. But if you sold income-producing property, like a rental property or property that was used in a business, then that sale is reported on the 6252, and then it carries to the 4797. And actually, there's calculations that go on page 2 of 4797. Then you do the 6252. Then you carry more numbers to the front page of 4797. And then when you're done with that, you go over to the Schedule D. So there's more steps there. Sale of business under the installment method. The installment sale of an entire business for one overall price under a single contract is not the sale of a single asset. So if you were to go out there and you saw a particular McDonald's franchise that was for sale and you decided you wanted to buy that going concern franchise, the IRS is saying that you don't just buy a business and treat it as the purchase of one thing, that you're going to have to look to the component parts that make up that business. And if you're the seller of the business, the same thing. You're going to have to divide that business into its component parts. And if it's being sold on an installment basis, you're going to have to apply the installment sale rules to each component of that business that was sold, and so on. So let's look at how the allocation of that selling price works. To determine whether any of the gain on the sale of the business can be reported on the installment method, you must allocate the total selling price and the payments received in the year of sale between each of the following classes of assets. The assets that were sold at a loss, real and personal property that is eligible for the installment method, and real and personal property that is not eligible for the installment method, including inventory, dealer property, and stocks and securities. Firstly, let's look at inventory. The sale of inventories of personal property cannot be reported on the installment method. All gain or loss on their sale must be reported in the year of sale, even if you receive payment in later years. If the sale agreement does not specify how much of the sales price is for inventory and the other assets sold, then each payment must be allocated between the inventory and the other assets sold. Well, it's not all uncommon for a seller and a buyer of property to agree upon a selling price or a buying price without ever discussing the component parts. It's quite normal because they probably don't know that they need to do that. So ultimately, if they don't know that they need to do that, and they've had no guidance from attorneys who know they need to do that, or CPAs or other accountants or tax practitioners who know they need to do that, the likelihood is they're going to come to you to do their taxes, and they won't have had any accommodation for a breakdown of the component parts of the sales contract. And so it's going to be your responsibility to sit down with them and try and figure that out. Now, I've had situations where you could have the buyer go back to the seller and they could agree on it jointly after the fact. But more often what happens is if there was no agreement for it, I sit down with them, and to the best of our ability, we go through and look at the total sales price, and then we look at the value of all of the assets that they purchased. And how do we arrive at valuation? Essentially, what do they think the fair market value of what they purchased is? If they purchased a whole bunch of inventory, then what is the value of the inventory on the day of sale? They had to have looked at the inventory. Maybe they didn't count it at the time or realize that they needed to, but they're going to have to put a value on that inventory at the time of the sale. And then they're going to have to go through and look at the value of all of the physical assets that were sold: desks, furniture, display cases, physical things that they can identify that were sold. And pretty much once you're done with all of that, you're left with goodwill and going concern value. And so any amount that you can't contribute to hardcore assets is usually reserved for the going concern value and goodwill. And there is an exception to that, and that is if there are some notes or receivables, those are categorized into a different group again. But typically, I'm not seeing that happen very often, but you would need to account for it if you did have it. So if the sale agreement does not specify how much of the selling price is in for inventory and the other assets sold, then each payment must be allocated between inventory and the other assets sold. Report the amount you receive or will receive on the sale of inventory items as ordinary business income, such as the part of gross receipts on Schedule C. Use your basis or cost in the inventory to figure the cost of goods sold. So you've sold a business, and the business had inventory that was included with it. Let's just say you sold a toy store, and there's a whole bunch of toys on the shelf. What the IRS is saying is that you're going to have to put a value on those toys that were sold, and you're going to have to report the value of that inventory as income in the year of sale. And you're going to go, well, if I didn't get any payment for that inventory, does that seem quite fair? Well, the answer is yes, because it's going to even out, because your ending inventory would be zero. You're going to have opening inventory, and then at the end of the year, your ending inventory will be zero. So you're going to get income from it, but you're also going to get a deduction for it under the cost of goods sold rules. Residual method. Except for assets exchanged under the like-kind exchange rules, both the buyer and the seller of a business must use the residual method to allocate the sales price of each business asset that is sold. This method determines gain or loss from the transfer of each asset and the buyer's basis in the assets. The residual method must be used for any transfer of a group of assets that constitutes a trade or business and for which the buyer's basis is determined only by the amount paid for the assets. This applies to both direct and indirect transfers, such as the sale of a business or the sale of a partnership interest in which the basis of the buyer's share of the partnership is adjusted for the amount paid under Section 743B. A group of assets constitutes a trade or business if goodwill or going concern value could, under any circumstances, attach to the assets or if the use of the assets would constitute an active trade or business. The residual method provides for the consideration to be reduced first by cash and general deposits, including checking accounts but excluding certificates of deposit. The consideration remaining after this reduction must be allocated among the various business assets in a certain order. And this reporting requirement is fulfilled by completing Form 8594. That's the form where you report the sale of a business or the purchase of the business, depending on which side you are. In our case, we're working as the seller, so we would be filling out 8594 as the seller. So let's take a look at reporting requirements for Form 8594. Both the buyer and the seller involved in the sale of business assets must report to the IRS the allocation of the sales price among Section 197 intangibles and other business assets. You use Form 8594 to provide this information, and it must be attached to the tax return of both the buyer and the seller. Typically, if they're working together and there is a written agreement spelling out the agreed upon allocation of sales price, they could fill out 8594 and they both have the same numbers on there. But it's also possible that there was no agreement on it and they can't agree on it, and so they're going to fill it out each in their own way. For asset acquisitions occurring after March 15, 2001, make the allocation among the following assets in proportion to, but not more than, their fair market value on the purchase date and in the following order: certificates of deposit and U.S. government securities, accounts receivable or other debt instruments, property of a kind that would properly be included in inventory, all other assets except Section 197 intangibles. And all other assets is essentially all of the items that are physical that you can see and touch, pretty much the Section 1245 and Section 1250 property, such as furniture, buildings, anything that's used for income production that is not inventory. And then number 5, Section 197 intangibles except goodwill and going concern value, and then finally goodwill and going concern value. And a Section 197 intangible that would not be goodwill or going concern value might be the value of a franchise, for example, or the value of a copyright. Those could be 197 intangibles. Now, if an asset described in lines 1 through 6 is includable in more than one category, included in the lower number of category. For example, if an asset is described in both 4 and 6, included on line 4. Agreement: the buyer and the seller may enter into a written agreement as to the allocation of any consideration for the fair market value of these assets. The agreement is binding on both parties unless the IRS determines that the amounts are not appropriate. Sale of a partnership interest. A partner who sells a partnership interest at a gain may be able to report the sale on the installment method. The sale of a partnership interest is treated as the sale of a single asset. The part of any gain or loss from unrealized receivables or inventory items will be treated as ordinary income, and the term unrealized receivables includes depreciation recapture income. The gain allocated to unrealized receivables and the inventory cannot be reported under the installment method, but the gain allocated to the other assets can be reported under the installment method. And for more information about the sale of a partnership interest under the installment method, do refer to publication 541. Recapture of depreciation for Section 1245 property. Section 1245 property is property used in trade or business for which depreciation was allowed or allowable in an earlier year. If you report the sale of property under the installment method, any depreciation recaptured under Section 1245 is taxable as ordinary income in the year of sale. This rule applies even if no payments are received in that year. If the gain is more than the depreciation recapture income, report the rest of the gain using the installment method rules. So remember earlier when I was showing you the illustration for was it Sally's sale there, where I said, hey, look, we've got $2,000 of recovery of depreciation, and that's going to be treated as a reduction to basis? Well, that was possible because it was Section 1250 property. But if she had been selling 1245 property, she wouldn't have been allowed to reduce her basis in that way. She would have had to have entered the recapture of depreciation on that lower line, or that higher numbered line, and it would have become income to her in the year of the disposition. So recapture of Section 1245 property creates income in the year of sale, but recovery of Section 1250 property is treated as a reduction to basis in the year of sale. Section 1250 property is real property that is used in a trade or business. Gain on the sale of Section 1250 property can generally be reported using the installment method, provided the property was held for more than 1 year and was depreciated using the straight line method. If the property was held for 1 year or less, all gain is taxable as ordinary income. And here is an illustration. Recapture or recovery of depreciation on an installment sale. Farmer Brown sells his farm business under an installment agreement. His adjusted basis in the land and buildings is $700,000 with accumulated depreciation of $80,000. As a part of the sale, Farmer Brown also sells farm equipment with a basis of $100,000 and accumulated depreciation of $70,000. The sales price is allocated as follows: $1 million for the farm and land and buildings, and $80,000 for the equipment. The buyer's combined down payment and installment principal payments to Farmer Brown total $40,000 for the year. You're going to figure Farmer Brown's taxable income for the year of sale as follows. Firstly, we look at the farm sales price, which is $1 million. We then look to the basis of the property, which is $700,000, and we subtract out the prior depreciation to get a farm adjusted basis of $620,000. The sales price is $1 million. We subtract out the adjusted basis, and we get the profit or the gain on the sale. The gain on the sale of the farm real estate is allocated as follows. Section 1250 gain from depreciation recovery is $80,000, and long-term capital gain is $300,000. Farmer Brown is going to be able to use the installment method on both of these numbers. He'll recover the $80,000 first, and it's taxed at the higher rate of 25%, the higher maximum rate of 25%, whereas the long-term capital gain amount is going to be taxed at the highest rate. 2012 is 15%, and 2013 it is 20%. Plus 2013, we're dealing with the additional Medicare tax that can come into play as well. But these two gain amounts are separated out because they have two different maximum tax rates that apply. We then look at the Section 1245 property. The equipment sales price is $80,000. The equipment had an original cost of $100,000, but prior depreciation has been $70,000, giving the adjusted basis of the equipment down to $30,000. We take the sales price of $80,000, subtract out the adjusted basis, and we have a Section 1245 gain of $50,000. Now, even though Farmer Brown received only $40,000 of payments during the year, he will be forced to report $50,000 of ordinary income from the sale because he is required to recapture all $50,000 of Section 1245 gain in the year of sale. However, because he's reporting all of the recapture of the Section 1245 income as income in the year of sale, he will have no installment income to report on the farm itself for the year. Now here is Form 4797, and on Part 3, which is page 2 of Form 4797, we report the sale of the farm and of the equipment, and we use column A to report the sales price of the farm, the cost in the farm, the depreciation claimed on the farm, and the adjusted basis and the gain. You can see that when we get down to the Section 1245 property, that the recovery of depreciation is actually carried down to line 25B. And from that point forward, 25B gets very different treatment than line 24. We move over to page 1 of 4797, and the minimum amount of income tax for the year is going to be $50,000. There's no installment income really being reported on the form this year. If there were installment income, it would be reported on line 4. You'd go to 6252, figure out what amount of installment income there is for the year. But in Farmer Brown's case, the amount is 0, so line 4 is blank. But because he has to recapture all of the Section 1245 depreciation, he's going to enter that on line 18B. And when he's done with line 18B, that will actually carry to his Form 1040, and it's going to get entered on line 14 rather than on line 13 where you see most Schedule D income appear. Here is Farmer Brown 6252 for the year of sale. He's got an installment sale going on the farm. He enters a description, the acquisition date, the sales date. It was not sold to a related party. He enters the sales price. He enters his cost. He subtracts out depreciation to get his adjusted basis. He carries the adjusted basis to line 13, subtracts it from line 5 to get his profit. And his gross profit ratio ends up being 28%. However, he receives no payments for the year, so he has no installment sale income for the year to enter on line 21. Let's talk next about repossession. Does it ever happen that you set yourself up an installment sale and then the buyer of the property defaults and you end up repossessing the property? I know it circulates in our office. We certainly have clients who have it happen to them. Just this past year, I was working with a client who I've done an installment sale, 6252, for him and his wife for every year I've ever done their taxes. And they actually have 3 different properties on installment sale, and one of them is a beach property. And I said, and what payments did you get on the property this year? And they said, nothing. They're in default, and we're going to see if they maybe pick it up and start making payments again. We're not sure that we want to repossess it, but we might have to. We're going to see. So it does happen. What do you do when there is a repossession of a property? If you repossess your property after making an installment sale, you must figure the following amounts: your gain or loss on the repossession and your basis in the repossessed property. Rules for figuring these amounts depend on which of the following three kinds of property you repossess. Did you repossess personal property, real property, or property that used to be your main home before it was sold? The repossession rules apply in both of the following situations, whether or not title to the property was ever transferred to the buyer. Either you foreclose on the property or the buyer voluntarily surrenders the property to you. It is not a repossession if the buyer puts the property up for sale and then you repurchase it. For the repossession rules to apply, the repossession must at least partially discharge or satisfy the buyer's installment obligation to you. The discharge obligation must be secured by the property you repossess. This requirement is met if the property is auctioned off after you foreclose and you apply the installment obligation to your bid price at the auction. How do you report the repossession? Well, you report the gain or loss from repossession on the same form that you used to report the original sale. If you reported the sale on Form 4797, then you would use that same form to report the gain or loss on the repossession. And conversely, if you use Schedule B and Form 8949, that would be where it would go as well. Figuring gain on repossession of real property. So I'm going to go through, just because of time, I can't really spend a lot of time on repossession, so I decided to go for the most likely type of repossession, which is going to be a repossession of real property. And the formula for the repossession of real property is different than for personal property. So if you end up in a situation where you have to figure an installment sale recapture for sale of personal property, you want to go to the instructions and follow those rather than what my manual is showing you. So in the manual here, I'm showing you the repossession of real property. Your gain on repossession is the difference between the following amounts: the total payments that you received or are considered to have received on the sale, and the total gain that you already reported as income. There is a limit on the amount of taxable gain. The taxable gain is limited to your gross profit on the original sale minus the sum of the following amounts: the gain on the sale you reported as income before the repossession and your repossession costs. The effect of this method of figuring taxable gain is to treat all payments received on the sale as income, but limits your total taxable gain to the gross profit you originally expected on the sale. So here is an illustration. I pulled this one out of IRS Publication 537, Gain on Repossession of Real Property. You sold a tract of land in January 2010 for $25,000. You accepted a $5,000 down payment plus a $20,000 mortgage secured by the property and payable at a rate of $4,000 annually plus interest at a rate of 9.5%. The payments began on January 1, 2011, and your adjusted basis in the property was $19,000, and you reported the transaction as an installment sale. Your selling expenses were $1,000, and you're going to figure your gross profit as follows. Firstly, you go to the selling price, $25,000. You take your adjusted basis, which is $19,000, and you add in the selling expenses of $1,000, a total basis to reduce from the selling price of $20,000. So 20 from 25 is 5, and 5 is your gross profit. For this sale, the contract price equals the selling price. The gross profit percentage is 20%. That is, 5,000 divided by 25,000 is going to give you that 20%. In 2010, you included $1,000 of income on your tax return. If you go up, you can see that there was a $5,000 down payment. If the gross profit percentage is 20%, 20% of 5 is 1, and so in the year of sale, you included $1,000 of income. The next year, you received $4,000 of income, and since the gross profit percentage is 20%, 20% of $4,000 is $800. So the total amount from the sale that you've included in your income since you sold it is going to be $1,800, $1,000 plus $800. But the total amount of payments you received since you sold it is $5,000 plus $4,000, or $9,000. And then in 2012, the buyer defaulted and you repossessed the property. You paid $500 in legal fees to get the property back. Your taxable gain on the repossession is figured as follows. So we go over to line 1 and we enter the total payments received before the repossession, which were $9,000. And you enter the total payments that were included as income so far, and that's $1,800. You subtract the 18 from the 9 and you get $7,200. The IRS says your gain from the repossession is $7,200. Your gross profit on the original sale, however, was only $5,000, less than the gain on the repossession. And then you also have the cost of repossessing the property. What IRS wants you to do is to take line 2, $1,800, and add that to line 5, $500. And when you do that, you get $2,300. It then says subtract line 6 from line 4, which is the 5,000. So you're going to take 2,300 from the 5,000. When you do that, you get 2,700, and IRS says that 2,700 is therefore your taxable gain. Now what happens next? Well, you now have property that you have repossessed. You've paid tax on the repossession. And now how do you figure out what your basis is in the property? Now that you've got it, you're going to either start depreciating it again because it's being used for business. You decide to turn it back into a rental, say, or maybe you decide to sell it again. And when you sell it, you're going to have a cost basis to figure out your next profit from the sale. So basis in repossessed property. Your basis in the repossessed property is determined as of the date of the repossession, and it is the sum of the following amounts. Your adjusted basis in the installment obligation plus your repossession costs plus the taxable gain on the repossession. To figure your adjusted basis in the installment obligation at the time of the repossession, multiply the unpaid balance by the gross profit percentage, then subtract that amount from the unpaid balance. The IRS has a series of worksheets in its publication 537, a bunch of them, and you can tell alphabetically worksheet E is getting up there. It's like the fifth one, A, B, C, D, E, right? You're up to 5 worksheets by the time you get to this one, and there's a whole bunch of others. And so just because of time limits, I'm not showing them all, but this one is a rather important one. And it says, enter the unpaid balance on the installment obligation. Well, if we go back up here and say, what is our unpaid balance? The selling price is $25,000, and you received $9,000 of payments right here. So you're going to take 9 from 25, and that means $16,000 is outstanding. And that is what you would enter on line 1. So let's take a look at that illustration in terms of figuring basis using this worksheet and actually fill out the worksheet down here. In the previous illustration, you repossessed a tract of land that had an original cost of $20,000, a contract price of $25,000, and resulted in a $5,000 gain that has a 20% gross profit percentage. At the time of the repossession, you had received $9,000 of payments, leaving the unpaid balance in the contract at $16,000. Your cost of repossessing the property was $500, and your taxable gain on the repossession was $2,700. Fill out the worksheet. So you'll go and you'll enter that $16,000 that I already explained on line 1. You'll then multiply that by the gross profit percentage of 20%, and that gives you $3,200. This is the amount of unrealized profit from the sale. Then you'll subtract line 3 from line 1, and when you do that, you get $12,800. You then enter your taxable gain from the disposition of $2,700. You enter your cost for repossessing the property, and look at that. You're all the way back to where you started, $16,000. So $16,000 is the basis in that repossession of real property. Now here I'll just touch a bit on the repossession of personal property and how that differs. If you repossess personal property, you may have a gain or loss on the repossession. In most cases, you may also have a bad debt. To figure your gain or loss, subtract the total of your basis in the installment obligation and any repossession expenses you have from the fair market value of the property. If you receive anything from the buyer besides the repossessed property, you add its value to the property's fair market value before making the calculation. How you figure your basis in the installment obligation depends on whether or not you reported the original sale under the installment method. The method you use to report the original sale also affects the character of your gain or loss on the repossession. So if you do have a repossession of Section 1245 property or personal property, you're going to need to read some more instructions, and those can be found on pages 12 and 13 of IRS Publication 537. You may recall me mentioning that there is a section of the 6252 form to fill out if you sell property to a related person. The following additional reporting requirements and restrictions apply if you sold property to a related person for the year. For the year of sale, complete lines 1 through 4 in parts 1, as well as parts 2 and 3 of Form 6252. And then essentially it's going and having you answer all of these questions relating to the related party. You have to identify information about the related party and the fact that this is a sale to a related party. The importance of it is that if there is a disposition of that property by the related property in a subsequent year, special treatment is going to apply to you. So you have a related party, you sell an installment sale to them, and then subsequent to that, that related party sells the property, and that will have an impact on you. So generally, a special rule applies if you sell or exchange property to a related person on the installment method. This is called a first disposition. And then that related party sells, exchanges, or gives away the property, which is called a second disposition. In the following circumstances, there's going to be items that affect you. The related person makes a second disposition before making all payments on the first disposition, or the related person disposes of the property within 2 years of the first disposition. This rule, however, does not apply if the property involved is marketable securities. Under this rule, you treat all or part of the amount the related person realizes, or the fair market value of the disposed property is not sold or exchanged, from the second disposition as if you had received it at the time of the second disposition. So in other words, if the related party sells the property and meets these requirements up here, then you get to report the gain on your return. And you should refer to Publication 537 for additional information on rules and reporting requirements. So everything I've been talking to you about is what you do when you have an installment sale, but it is possible to have an installment sale and then elect out of the installment method. If you elect not to use the installment method, you generally report the entire gain in the year of sale, even though you do not receive all sales proceeds in that year. How do you elect out? To make the election, do not report your sale on Form 6252. Instead, report it on Schedule D or Form 4797, whichever applies. When to elect out? If you're going to elect out, you need to do it by the due date, including extensions for filing your tax return for the year of sale. Now, there is an automatic extension. If you timely filed your return without making the election, you can still make the election by filing an amended return within 6 months of the due date of the original return, excluding extensions. And then you would write filed pursuant to Section 301-91002 at the top of the form. Once you make the election to not use the installment method, it is generally irrevocable. If you wish to revoke that election, you'd have to get IRS consent. And it says here, do you have to pay tax on the gain on repossessed property? And the answer is yes, Keith. That was what I was showing you there, is that whatever amount of gain is taxable is going to be included in your income for that year, and it would be taxed at whatever rate applies to the income. So in our situation here, we have $2,700 of income from the repossession that is treated as income in that year. I can see some logic in what you're saying, but the IRS is saying in the life of that contract, you actually received $9,000 of payments, and you've only included $1,800 of those payments in your income at the time of the repossession. They're only going to have you include in income the difference between those payments and the gain on the sale minus the repossession costs of $500. So ultimately, the $2,700 is the amount that has to be included in an income, even though $9,000 has actually been collected over time. So theoretically, you have got the cash. You just don't have the cash in the year of the repossession. Took me a bit of understanding this too, and I'm reading through the instructions in Publication 537 on this. The first time I read it, I didn't get it. I had to kind of read it, refuse to understand it for a few hours, and then go back to it. And once I went back to it, it made sense. I don't know. You can't have an installment sale on stock. You're allowed to have an installment sale on a partnership. I don't know that you can sell an S corporation on an installment sale. It's just the partnerships, because you can't do it on stock. So what you would have is you would sell the assets of the S corporation under the installment sale. You wouldn't sell the stock under the installment sale. That would be what would happen. So I'm looking here. If you have a business that was sold under the installment method, and you're essentially saying 6252 should have been filled out and wasn't? Yeah, the IRS rules about installment sales is they apply to only certain types of property, and they do allow the interest in a partnership to go under the installment method, because ultimately your interest in a partnership is an interest in all of the assets of the partnership. And you compare that to ownership of stock in a corporation. You own the stock in the corporation, but the corporation is a separate entity and it owns its own assets. So when you sell a corporation, you can sell the stock, but more often what actually happens is people sell the individual assets that make up the corporation. And one of those assets could be the value of the name of the corporation. But generally, the recommendation is that a person not buy the stock in the S corporation, but rather buy the assets of the corporation, because in that way, you are not also purchasing the liabilities of the corporation or the potential for being sued at a later point. It's typically not recommended that you purchase stock in an S corporation, but rather you purchase the assets of the corporation. And then small business stock per se, that is typically in a C corporation. So an S corporation stock is not per se small business stock. B, B-E-E, B. All right then, like-kind exchanges. We're going to be taking a look at IRS Form 8824 and all of the rules surrounding how to figure a like-kind exchange and when you actually have a like-kind exchange that is allowed for and provided for under the law. We're going to start with the introduction at the top. Now, like-kind exchanges is a fairly advanced topic. We're assuming that you understand a great deal about capital gains and how to refigure basis and depreciation and all of those items before we ever get to the point where we're dealing with a like-kind exchange. And yet, having said that, I can recall the first like-kind exchange I ever dealt with in my practice as a tax preparer was very, very early in my career when I really had very little idea of what to do. I'd never done one. I'd never had education in one. And yet I had a client who wanted me to prepare a like-kind exchange form for him, and I somehow managed to get my way through it. But I remember the whole time thinking I'm quite confused. And over the years, I would have other people come who have done like-kind exchanges, and I'd need to fill out that 8824 form, and I was just never really happy with how it worked. So when it came down to actually do an illustration of Form 8824 for a course in teaching it, I really spent a lot of time going through IRS instructions, and they're abysmal. They're terrible. The IRS instructions are absolutely dreadful. And over the years, in talking with IRS auditors over the phone, IRS trainers over the phone, I've gotten contradictory information about what is correct. Ultimately, one of the best sources of information on like-kind exchanges that I've been able to find is on the internet from sources other than IRS. But I cautiously tell you about them because these sources are not official in any way. You couldn't rely on what they're saying in a court of law. In a court of law, you would need to be able to cite actual court cases or IRS instructions or the code itself to defend a particular position. But let's assume that the sites I'm taking you to are being populated with information by people who have a lot of experience and have done a lot of that research for us, and they'll have some interesting information. And one of the best sites I've found is something called 1031 Exchange. And I have a link in the manual to a form that they have. So when we get to that point, if there's time in the class, I may even take you and show you their site a little, just because if after today's class you're feeling a little bit empty and you want a little bit more, I find that the information they provide can be worthwhile. Yesterday I went to the IRS website and just did a search engine for like-kind exchange court rulings. And when I did that, I came up with a number of court rulings that if I'd had lots and lots of time, as in weeks, I could sit there and start reading them. Because ultimately, when it comes to like-kind exchange and how the IRS is going to address a particular like-kind exchange issue, the reality is that the like-kind exchange stance or the opinion of the IRS is very often in opposition to the courts. So if you want to take a position on a tax return in terms of the rules of how you're going to interpret the like-kind exchange, you may do so in a fashion that satisfies your client, but may not necessarily satisfy an IRS auditor. And so what would happen if it did go to court? Would the court rule in the favor of the taxpayer or the IRS? And interestingly, very often with like-kind exchange situations, the court does rule in favor. And I just randomly picked two court cases to look at yesterday. And in the first court case, the taxpayer didn't have a leg to stand on and was ruled against. And in the second one, it went on page after page after page after page. And when it was finally done, the court ruled in favor of the taxpayer and said the IRS didn't have a leg to stand on. So it's difficult to teach a course when the IRS instructions are bad and then IRS auditors give differing information. So really today's class is compiled from IRS instructions, just things I happen to have learned along the way. Some of the opinions and information that I've seen posted on websites of 1031 exchange type groups that specialize in this. And hopefully when it's all done, you've got some sort of a sense today of how the like-kind exchange rules work. So let's begin with the introduction. In certain situations, it is possible for a business to defer or delay taxation of capital gains and losses where an asset used for income production is traded for a similar asset also used for income production. IRS regulations actually require the deferral of gains and losses on the exchange of property that is like kind. In other words, the rules are mandatory. Earlier today, we talked about installment sales and how the rules that apply to installment sales are automatic unless a taxpayer elects out of the installment method by reporting the entire gain in the year of sale. When it comes to IRS like-kind exchanges, however, the like-kind exchange rule is always mandatory. In other words, if you have a like-kind exchange, you must follow the rules for like-kind exchange, and you can't elect out of them somehow. So let's talk about the rules. First, I'm going to start by summarizing the rules, and then we'll go into each rule in more detail. An exchange of property will be considered to be a like-kind exchange only if all rules applying to like-kind exchanges are met. These rules are summarized as follows. Number 1, investment or income property only. In a like-kind exchange, both the property you give up and the property you receive must be held by you for investment or for productive use in your trade or business. Rule number 2, the property must be qualifying property. In addition to being held for investment or business use, property must be qualifying property. Certain types of non-qualifying property are not allowed in Section 1031 exchanges. Like kind, both the property given up and the property received must be like kind. 45-day identification period. The property received must be identified within 45 days after the property given up in the exchange is transferred. Rule number 5, 180-day receipt period. The property received must be received by the earlier of 180 days after transfer of the property given up in the exchange, or the due date of the return, including extensions for the year the property given up is transferred. Rule number 6, boot is taxable. Any money or unlike property received in the exchange is considered to be boot. Liabilities received by the other property are also considered to be boot. Liabilities transferred to the other party in an exchange in excess of liabilities assumed by the taxpayer are treated as boot. Like-kind exchange rules are mandatory. Gain or loss realized on the exchange of like-kind property must be deferred and is not recognized. Related party exchanges are subject to additional rules. Related taxpayers who sell or otherwise dispose of exchanged property within 2 years must recognize gain or loss in the year the disqualifying disposition originally occurred. Depreciation treatment. The maker's depreciation method, convention, and placed in service date that applied to the old property will continue to apply to any basis transferred to the new property. If the basis of the new property is greater than the basis of the old property, any additional amount added to basis will be depreciated beginning on the date the new property is acquired. Rule number 11, sale of home. You may not exclude gain on the sale of your home if you sell your home within 5 years of acquiring it in a like-kind exchange. And finally, rule number 12, reporting. Form 8824 must be used to report the exchange of like-kind property. So we're going to take each of these 12 rules in turn and in more detail, spending time on each one to get a more thorough understanding of what each rule is about. And we'll begin with rule number 1, which is investment or income property only. In a like-kind exchange, both the property given up and the property received must be held by you for investment or business purposes. Examples of property that may qualify include machinery, buildings, land, trucks, and rental houses. Rental property must not have more than 14 days of personal use, however. Qualifying property must not be used for personal use for more than 14 days per year or 10% of the actual number of days that the property has been rented in a given year. So what Iris is saying is that the like-kind exchange rules do apply to rental property, but if you make personal use of that rental property that exceeds the 14-day limit, then the like-kind exchange rule would not be allowed for that exchange. Replacement property cannot be purchased with the intent to sell immediately. You cannot defer gain in a like-kind exchange if you intend to immediately sell it. You must acquire the property with the intent to hold it for use in your business or for investment purposes. So how long does my property need to be used for business to qualify? The IRS gives no specific instructions on how long property must be held for investment or business use. However, a good guideline is to follow a minimum of 1 to 2 years of ownership. So You have property, it's been used in a business, you trade it for more property to use in your business, but in the back of your head you're thinking, well, I think I might want to actually convert this to personal use. And how long do you have to hold it before you're allowed to do that? Or maybe in the back of your mind at the time you make the trade, you're thinking, no, I plan on selling this. I don't really want to hold it for business use for very long. How long do I have to hold it to really be able to benefit from these like-kind exchange rules? A guideline is 1 to 2 years, but the IRS doesn't actually say 1 to 2 years anywhere. That's just kind of general rule of thumb that the industry follows. The burden of proof with regards to showing business or investment use falls to the taxpayer, and there is no safe harbor holding period for complying with the held for requirements. Although I say 1 to 2 years, the IRS doesn't say 1 to 2 years. They don't really give a definition at all. There's no safe harbor number that they're giving. So instead, what happens is the IRS will look to the intent of the taxpayer. The IRS will determine intent by considering facts and circumstances surrounding a taxpayer's acquisition of ownership of property and what use the taxpayer makes of the property. IRS interpretation of intent tends to be more conservative than with the courts in these matters. Examples of transactions that might cause IRS to question whether property is held for business or investment use include: the taxpayer acquires replacement property and then immediately lists the property for sale. The IRS will interpret the intent is to acquire the property for resale rather than for investment purposes. Or the taxpayer acquires replacement property and then immediately converts the property to a personal residence. Or the taxpayer acquires replacement property and then immediately transfers the property to a corporation, partnership, or LLC. Rule number 2. The relinquished property must be qualifying property. To qualify for tax deferral under the rules for like-kind exchanges, there must be a trade or exchange of qualifying property. Qualifying property is property held for investment purposes or used in a taxpayer's trade or business. Investment property generally includes real estate, whether it's improved or unimproved, held for investment or income-producing purposes. Qualifying property used in a trade or business can include farmland, office buildings, and rental real estate, equipment used in the trade or business activity, Section 197 intangible assets such as copyrights, except for goodwill and going concern value. Property that does not qualify for Section 1031 exchange includes a personal residence, land under development for resale, construction or fix flips for resale, property purchased for resale, inventory property, corporation common stock, bonds, notes, partnership interests, goodwill, and going concern value. Rule number 3, the property exchanged must be like-kind. To qualify for a like-kind exchange treatment, both the property given up and the property received must be like-kind as defined by the IRS. In addition, the property given and the property received must be qualifying property. How do you determine if the property given and the property received are like-kind? Well, to be allowable, the asset given up and the asset received must be of like kind or of like class. Like-kind properties are properties of the same nature or character, even if they differ in grade or quality. Property must generally belong to the same asset class or the same product class. And here are general asset classes, and you can find these general asset classes in the regulations under Section 1031, and they are summarized as follows. And actually, the place where you see these asset classes as well is inside IRS Publication 946, which is the publication IRS has on depreciation. If you flip to the very back of that publication, there is the appendices, where they list asset classes and the types of assets that fit into those classes. So Publication 946 is where I get this information. Office, furniture, fixtures, and equipment all belong to the same asset class, which is 00.11. Information systems such as computers and peripheral equipment belong to asset class 00.12. Data handling equipment, except computers, is in a different class. Airplanes, including airframes and engines, but not airplanes used in commercial or contract carrying of passengers or freight, and all helicopters. Automobiles and taxis belong to the same class. Buses belong to a class by themselves. Light general purpose trucks are in a different class than heavy general purpose trucks. Railroad cars and locomotives, except those owned by a railroad transportation companies, belong to a particular class. Tractor units for use over the road belong to an asset class, and trailers and trailer-mounted containers belong to a different class. Vessels, barges, tugs, and similar water transportation equipment, except those used in marine construction, all belong to the same class, which is 00.28. And finally, industrial steam and electric generation or distribution systems belong to class 00.4. So again, all of these asset classes are shown in the back of the appendices for publication 946. If you are dealing with an exchange of property and you don't see that the property exchanged belong to the same class, then you may not have a like-kind exchange. But you still could have a like-kind exchange if they belong to the same product class. So where do you go to find out if they belong to the same product class? Well, you go to the North American Industry classification system called NAICS. And there's actually a link that I put in the manual here to their website. If you click on the link in the manual, it will take you to the page where you can actually access this directory. You can order a directory and pay money for it, or you can just access the content of the directory online for free. So it will download to your computer in the form of an Excel file. So let's take a look at some examples where we have property that is considered to be like kind because it is either like class, it's in the same product class, or it's in the same asset class. It's one of those two situations is met. And we'll also see examples where property doesn't qualify because it is not in either the same asset class or the same product group. Here's an example. Charlotte trades a personal computer used in her business for a printer to be used in her business. The properties exchanged are in the same general asset class as 00.12, and therefore they are like class, and therefore they are like kind. Example number 2, Wilbur transfers a grader belonging to NAICS code 333120 to Ron in exchange for a scraper that also falls into the same code 333120. Both are used in a business. Neither property is within any of the same general asset classes, but both properties are within the same product class and are therefore like class. So what I did is yesterday I went through and took a look at the 2012 NAICS codes. The last time I really looked at the NAICS code book, it was still showing 2007 codes, and they have totally changed all of the codes for 2012 and later years. But I went through and just kind of pulled some out just to show you how that particular system works. And what I've done is if you look in this table here, you can see codes. We've got 311313, and it appears twice. There's a lot more lines that have that same NAICS code. I just randomly picked 2 so you could see how NAICS is categorizing these things. Essentially, we've got granulated beet sugar manufacturing and liquid beet syrup manufacturing. Equipment purchased and used for either of those two functions would be the same function or would be like kind as far as IRS is concerned. And then we have one here that is 311710, seafood and seafood products canning, and soup, seafood, and manufacturing. They're all under the same code, and there's many other items under that same code as well. Lumber, kiln drying, and rails, except rough wood fencing manufacturing, are in the same class as well. And then we have comic books, commercial printing, except screen without publishing, are in a different class than the comic books themselves. And then here is our Ron and Wilbur with the grader and the scraper. And you can see when I went into the NAICS codes that they do have the same NAICS code, and that's why a like-kind exchange will be allowed. And then I just randomly picked one more with the same NAICS code, so you could see that a mortar, mixer, portable used in manufacturing could also be considered like kind to a grader or a scraper. And there are other assets as well. And then we move on to example number 3. Taxpayer G transfers the following property to H: a personal computer in asset class 00.12, an airplane in asset class 00.21, and a sanding machine which has NAICS code 333243. You can see that's this one right here in green. H transfers the following property to G: a printer in asset class 0.12, a car in asset class 0.22, and a saw with NAICS code 333243. So what you should be seeing here is that the personal computer and the printer belong to the same asset class, so their trade will be considered like kind. The airplane and the car are in different classes, and so that trade will not be considered like kind. And then we have the sanding machine and the saw, and their trade will be considered like kind because they belong to the same NAICS code. Rule number 4, replacement property must be identified within 45 days. You must identify the property to be received within 45 days after the date that you transfer the property given up in the exchange. This period of time is called the identification period. Any property received during the identification period is considered to have been identified. If you transfer more than one property as a part of the same transaction, and the properties are transferred on different dates, the identification period and the receipt period begin on the date of the earliest transfer. Identifying replacement property. You must identify the replacement property in a signed written document and deliver it to the other person involved in the exchange. You must clearly describe the replacement property in the written document. The following are examples of acceptable descriptions: the legal description or street address for the real property and the make, model, and year for a car. In the same manner, you can cancel an identification period of replacement property at any time before the end of the identification period. So you may see here make, model, and year of car. One of the most common like-kind exchange scenarios out there is really trading an old car for a new car. Have any of us ever gone to a dealership and traded in an old car and bought a new car? Most of us at some point have done that or will do that because it's one of the most common types of trades that goes on out there. And as far as IRS is concerned, if you trade a business use car for another business use car at a dealership, you have a like-kind exchange. And so in this situation, if you were filling out 8824 because an old car was traded for a new car, then you would be entering the make, model, and year for the car as a description. And of course, when our clients come to us because they did a like-kind exchange, most of the time they're thinking in terms of real estate. But the more likely type of scenario that we'll run across in just the everyday job of being a tax practitioner is this trade-in of a car. Identifying alternative and multiple properties. You can identify more than one replacement property. Regardless of the number of properties you give up, the maximum number of replacement properties you can identify is the larger of the following: 3 properties regardless of the fair market value, or any number of properties whose total fair market value at the end of the identification period is not more than double the total fair market value on the date of transfer of all properties given up. If, as of the end of the identification period, you have identified more properties than is permitted under this rule, the only property that will be considered identified is any replacement property you received before the end of the identification period, and any replacement property identified before the end of the identification period and received before the end of the receipt period, but only if the fair market value of the property is at least 95% of the total fair market value of all identified replacement properties. Fair market value is determined on the earlier of the date you received the property or the last day of the receipt period. Okay, if after reading that your head is spinning, well, I don't wonder with that because it's really hard to make sense of. But QuickFinder has a nice little table that summarizes those rules, and so I copied their table and stuck it in my manual. And you can see here that what they've done is they've basically taken the rules and put them into columns. So let's look at the first one that says the total number of properties that can be identified. Under the 3-property rule, the maximum number of properties is 3. Total number of properties that can be identified is 3. Under the 200% rule, there's no limit on the number of properties that can be identified. And under the 95% rule, there's no limit on the number of properties that can be identified. If you're looking at the total fair market value of the properties identified rule, then you would go over to the 3-property rule, and there is no limit that applies. Under the 200% rule, you would have 2 times the disposition price of the property being relinquished. So essentially, you can either fall under the 3-property rule or the 200% rule. But if you fall under the 200% rule, you can have any number of properties. It's just that the total value of the properties cannot exceed 200% of the property being given up. And then we finally have the 95% rule. If you fall under the 95% rule, then there's no limit on the number of properties, and you're obviously already not under the 200% rule. So if you end up with a customer who is trading multiple properties for a single property, or one property for multiple properties, or a combination of the two, you have to be aware of these limits: the number of properties, the 200% rule, or the 95% rule. And they don't have to meet all of them. They can meet only one of them. So what that's saying is, let's just suppose you have a client who is trading an apartment building worth $1 million and wants to buy 5 houses with that money, or do the trade into 5 houses. Well, 5 is more than 3, right? So that could create a problem. But as long as the value of the 5 houses is not more than 200% of the value of the apartment, it would still be allowed. So that's essentially what is being said here. Disregard incidental property. Do not treat property incidental to a larger item of property as separate from the larger item when you identify replacement property. Property is incidental if it meets both of the following tests. It is typically transferred with the larger item, and the total fair market value of all incidental property is not more than 15% of the total fair market value of the larger item of property. Now, rule number 4, the replacement property must be identified. What this is essentially saying is I've involved an intermediary, or typically these would involve intermediaries. You go and you've identified an item of replacement property that you want to trade for, and you're selling your existing property. From the time that you sell your existing property, you have only 45 days to identify the replacement property. And then from the time you identify that replacement property, you actually have to take possession of it within 180 days. So these limits are important and can make individuals who are participating in a like-kind exchange difficult to work with if you are a buyer or seller of property and you are not the person engaged in a like-kind exchange. So for example, if you have someone who is selling a house and a buyer comes along and says, yeah, I want to buy your property, I want to do it in a like-kind exchange, then as the seller, that should concern you, because when they're telling you that they want to involve themselves in a like-kind exchange, it means that your house is not going to be able to close until they've pretty much identified a buyer for their property, because everything has to happen within 45 days for identification and within 180 days of the actual close of the sale. So people involved in like-kind exchanges are not necessarily the most desirable buyers, but they can still be okay to work with as long as they're organized and can put it all together. So let's look at the next rule, which is the 180-day rule, which is rule number 5. The replacement property must be received within 180 days. Gain or loss from a deferred exchange can qualify for non-recognition even if the replacement property is not in existence or is being produced at the time you identify it as replacement property. So what is the receipt requirement? Well, the property must be received by the earlier of the following dates: 180 days after the date on which you transfer the property given up in the exchange, or the due date of the return, including extensions, for the tax year in which the transfer of the property given occurs. Like-kind exchanges using qualified intermediaries, because typically it's going to be pretty hard to find someone who wants to take your property in exchange for their property. And the exception to that would really be dealers. If you go to a car dealership with your old car and want to trade it in with a new car, you're not going to be dealing with an intermediary. But odds of finding a piece of real estate where you're going to find someone who wants to trade their real estate for your real estate, that's not going to happen too often. It could happen, it's just not too likely. So the way around that is to use a qualified intermediary. And what happens with a qualified intermediary is this can be a title company, often is a title company. And essentially the title company is going to buy your property from you. And they're also going to buy the other property from the seller of that property. And then the qualified intermediary, as owner of that other property, is going to trade it to you. So the act of involving yourself in a like-kind exchange with an intermediary basically means that there's 3 parties to the transaction. There's the seller of the property you want, there's you as the seller of the property you want to give up, and then there's this intermediary in the middle. And the intermediary has to take possession of both properties and then trade them with you. So that's how they work. So exchange intermediaries make it possible to achieve a qualifying like-kind exchange in situations where direct exchange between 2 interested parties is difficult or otherwise unlikely to occur. If you transfer property through a qualified intermediary, the transfer of the property given up and the receipt of the like-kind property is treated as an exchange. This rule applies even if you receive money or other property directly from a party to the transaction other than the qualified intermediary. Qualified intermediary. A qualified intermediary is a person who engages in a written exchange agreement with you to acquire and transfer the property you give up and acquire the replacement property and transfer it to you. This agreement must expressly limit your rights to receive, pledge, borrow, or otherwise obtain the benefit of money or other property held by the qualified intermediary. There are 4 different kinds of exchanges. Exchange intermediaries describe 4 different types of exchanges that may be completed under like-kind exchange rules as follows. Firstly, we have the simultaneous exchange, and this may be the one that you most commonly think of, but it doesn't mean that it's the only kind. And a simultaneous exchange is an exchange in which the closing of the relinquished property and the replacement property occur on the same day, usually back to back. There's no interval of time between the two closings. But as we know from the 45-day rule and the 180-day rule, that it's not required that you do it that way. You could actually close at another time. One of those ways of closing is something called a delayed exchange, also called a starker exchange. This is an exchange where the replacement property is closed on at or on a later date than the closing of the relinquished property. The exchange is not simultaneous or on the same day. The type of exchange is sometimes referred to as a starker exchange after the Supreme Court case which ruled in the taxpayer's favor for a delayed exchange before the Internal Revenue Code provided for such exchanges. The next one is a reverse exchange, also called a title holding exchange. This is an exchange in which the replacement property is purchased and closed on before the relinquished property is closed. So not only can you be a seller involved in a like-kind exchange, you can also have a buyer involved in a like-kind exchange. And it could be the case that you find a buyer for the property that you're selling before you found the property that you want. So you sell what you've got and you still haven't acquired what you want to buy. And that's where you're in real danger because you've got to identify the property you want to buy within 45 days, and then you have to actually close on it within 180 days. So timing is very important and can be kind of stressful. Also, there's something called an improvement exchange, or another form of title holding exchange. This is an exchange in which the taxpayer desires to acquire property and arrange for construction of improvements to the property before it is received as replacement property. The improvements are usually a building on an unimproved lot, but also include enhancements made to an already improved property in order to create adequate value to close on the exchange with no boot occurring. The rules do not permit a taxpayer to construct improvements on a property as a part of a 1031 exchange after receiving title to the property as replacement property in the exchange. Therefore, it is necessary for the intermediary to close on, take title to, and hold the property until the improvements are constructed, and then convey the title to the improved property to the taxpayer's replacement property. So let's just suppose you have a piece of property worth $500,000 and you want to trade it for another piece of property worth $400,000. Under the like-kind exchange rules, you're going to have a problem because the property that you've selected as replacement property isn't worth enough. And so you could go out and identify a second piece of property and purchase two pieces of property that are both like-kind. That could be allowed. Or in this situation, what they're describing here is you tell the title company, hey, I've identified my replacement property. I want you to take title to that property, and I want you to make all of these improvements to the property, and then I want you to trade that property to me for the acquisition cost of $400,000 plus the cost of all of those improvements. And let's just say those improvements cost $200,000. So ultimately, you've got the $400,000 acquisition price, you've got the $200,000 of improvements that the title company or the intermediary agrees to do for you, and then they trade that property to you. And obviously, you're going to have to kick in some extra money or borrow some money to make that difference happen. Safe harbor method for reporting gain or loss when the qualified intermediary defaults. Do you think it's possible that you've identified an intermediary and that intermediary takes possession of your property and they're supposed to take possession of another type of property and then trade that with you, but somehow in that transaction they've taken your property from you and they haven't given you the replacement property? Could that ever happen? Apparently it has happened. Generally, if a qualified intermediary is unable to meet its contractual obligations to you or otherwise causes you not to meet the deadlines for identifying or receiving replacement property in a deferred or reverse exchange, your transaction may not qualify as a tax-free deferred exchange. In that case, any gain may be taxable in the current year. However, if a qualified intermediary defaults on its obligation to acquire and transfer replacement property to you because of bankruptcy or receivership proceedings, and you meet the requirements under Revenue Procedure 2010-14, you may be treated as not having actual or constructive receipt of the proceeds of the exchange in the year of the sale of the property you gave up. If you meet the requirements, you can report the gain in the year or years payments are received using the safe harbor gross profit ratio. And of course, there's a link here for more information on that one. The next rule is rule number 6. Boot received is taxable. The term boot is not used in the Internal Revenue Code or in the regulations, but it is commonly used in discussing the tax consequences of a 1031 tax-deferred exchange. Boot is an Old English term meaning something given in addition to. Boot received is the money or the fair market value of other property received by the taxpayer in an exchange, and all of the following are considered to be boot. Money, including all cash equivalents plus liabilities of the taxpayer assumed by the other party, and other property that is not like kind, such as personal property received in an exchange of real property used for personal purposes, or non-qualified property. Other property also includes such things as a promissory note received from the buyer, which is called seller financing. The best way to avoid boot is to always trade up by receiving replacement property of equal or greater value than the relinquished property. Trading down occurs where the replacement property has less value than the property given up, and trading down will always result in boot. And here is an example where we have an exchange where boot has been received. Joe operates a vintage car rental service which rents vintage cars for use in photography, movie production, and entertainment events. During the year, he traded a vintage 1999 Corvette Coupe with an adjusted basis of $40,000 for a vintage 1967 Z28 Camaro Coupe valued at $90,000. In addition to the Camaro, he received $10,000 of cash in the transaction. The cash is considered to be boot. Partially non-taxable exchanges. If, in addition to the like-kind property, you receive money or unlike property in exchange on which you realize a gain, you have a partially non-taxable exchange. So how do you figure the taxable part of such an exchange? You are taxed on the gain you realize, but only to the extent of the money and the fair market value of the unlike property that you receive. Therefore, the recognized taxable gain on the disposition of the like-kind property you give up is the smaller of two amounts. Number one, the amount of gain realized, or the limit on recognized gain. You need to follow these steps to figure out what the limit on recognized gain is. Number one, add the money you received plus the fair market value of any unlike property that you received. Reduce this amount, but not below zero, by any exchange expenses or closing costs that you paid. Compare that amount to your gain realized, and your recognized taxable gain is the smaller of those two. So what does that mean? Let's look at an example where it all comes together. This is a partially taxable exchange, and we have our character named Joe again. He trades his 1969 Corvette for a 1969 Camaro. His adjusted basis in the Corvette is $40,000, and at the time of the trade, the Corvette had a fair market value of $100,000. In addition to receiving the Camaro, he received $10,000 of cash boot to finalize the transaction. He also paid registration fees and taxes for the Camaro in the amount of $5,000. The transaction results in $55,000 of realized gain for Joe. The gain is partially taxable as follows. $5,000 is taxable, and $50,000 will be deferred. And all of these calculations will really be entered on the form 8824, and in a little bit I'll show you a completed 8824. But before you start filling out the 8824, it's helpful in your mind to really understand what portion of the gain should be taxed and what portion of the gain is going to get deferred, so that when you're finished filling out the form, it actually looks like it's supposed to. So let's look at the realized gain and how we ended up with that number. I've told you that we have $55,000 of realized gain, but here's the formula on how to get there, and this comes out of the instructions in IRS publications. Figure Joe's realized gain on the exchange of the Corvette as follows. Take the fair market value of the like-kind property received, in this case $90,000, and then add to that the cash received to get the total received, which is $100,000. You then subtract out the exchange expenses of $5,000, and you end up with the amount realized from the trade, $95,000. Then you subtract out the adjusted basis of the Corvette that was transferred of $40,000, and you're left with the realized gain again of $55,000. So this is the realized gain. What is the limit on the recognized gain? Although the amount of gain Joe realizes is $55,000, the taxable part of his gain will be limited to the amount of unlike property he receives minus his exchange expenses as follows. He looks to the cash he received, which is $10,000, and the exchange expenses are subtracted from that, and that's why his taxable gain is going to be $5,000. Rule number 7, liabilities assumed by the other party are considered to be boot. Offset all liabilities you assume as a part of the exchange against all liabilities of which you are relieved. Offset these liabilities whether they are recourse or non-recourse, and regardless of whether they are secured by or otherwise relate to specific property transferred or received as a part of the exchange. So you're dealing with a situation where you have property that you're trading. Let's just suppose it's real estate. Most people have real estate, or a large percentage of people who own real estate have a mortgage on that real estate. So if you're going to be doing a like-kind exchange involving real estate, odds are that there's a mortgage that's going to get paid off in there somehow. And then there's the situation of the property that you're acquiring. Is that going to be subject to a mortgage? Are you going to have to take out money to buy or exchange for that property? So IRS is saying if you have a mortgage on your property that is essentially assumed by the other buyer, and then you assume that other buyer's mortgage, you've got a trade going on there that involves these assumption of liabilities, and liability assumption is considered to be boot. So you have to be careful, really careful about how you arrange debt or construct debt when you do a like-kind exchange. So how do you avoid boot when you're dealing with liabilities in a like-kind exchange? Firstly, you always trade across or up and never down, the even or up rule. Trading down always results in boot received, either cash, debt reduction, or both. The boot received can be mitigated by the exchange expenses paid. Bring cash to closing of the relinquished property that cover charges which are not transaction costs. Do not receive property which is not like-kind. Do not overfinance replacement property. Financing should be limited to the amount of money necessary to close on the replacement property, in addition to exchange funds, which will be brought to the replacement property closing. And here's an example where debt relief can become taxable. Returning to our earlier illustrations, we're going to assume all the facts are the same, except that that Corvette that Joe traded, it was subject to an $8,000 note that the other party has assumed. You figure the amount of taxable gain for Joe as follows. Firstly, we figure his realized gain. Everything looks the same except we have an extra line inserted in. We figure his gain on the exchange of the Corvette by going to the fair market value of the property he's received, the cash that he received as boot, and the debt that is being assumed by the other party of $8,000. So it really means the amount he's receiving in that transaction is $108,000. He's still allowed to subtract the exchange expenses, then he ends up with an amount realized of $103,000. So the adjusted basis of the Corvette transferred is still $40,000, but now we've got a realized gain of $63,000. Limit of the recognized gain. Although the amount of gain Joe realizes in the sale is $63,000, the taxable part of his gain will be limited to the amount of unlike property he receives, minus his exchange expenses as follows. He's going to go to the money he received, cash, debt assumed by the other party, and add those numbers together, and then he's going to subtract out his exchange expense of $5,000 to get his recognized gain of $13,000. So in a situation like this, he would need to have replacement property that's worth more. That would be the way around this problem. But the replacement property is essentially worth a little bit less than the property he's given up, and so he's ending up in a boot situation. And then that boot situation is augmented by the fact that debt is being assumed. Rule number 10, maker's depreciation of transferred basis from old property continues under the new property. I see a lot of tax returns come across my desk that have been started at tax offices of other tax preparers. We have a new client that comes to us for the first time, and I often see errors in depreciation exactly of the type that's being described here. The IRS became aware of inconsistent depreciation treatment by taxpayers of property that has basis determined under Section 1031. Certain taxpayers were depreciating the replacement property using the same depreciation method, recovery, period, and convention as the exchanged or involuntarily converted property, while other taxpayers were depreciating the replacement property as if it was newly placed in service. In response to this, the IRS and the Treasury issued Notice 2000-4. And that notice provides instructions on how to depreciate maker's property that has a basis determined under a Section 1031 exchange. The notice stated that the replacement maker's property placed in service after January 3, 2000 is depreciated over the remaining recovery period of and using the same depreciation method and convention as the relinquished maker's property, and that any excess of the basis in the replacement maker's property over the adjusted basis of the relinquished property is treated as newly purchased maker's property. Well, how would that translate to a depreciation schedule on a tax return? Well, essentially, let's just suppose we've got the Corvette and the Camaro here. The Corvette has been depreciated over a period of time. It's in the depreciation features of the computer. And now it's been traded for the Camaro. Well, what would essentially happen is I, as a tax preparer, would go in there and I would put Corvette 1031 to Camaro, something in there so I understand that that line represents the original remaining basis of the Corvette and also of the Camaro. And of course, the only way this is going to work is if we have additional basis in the Camaro anyway, so we'd have to be creating an extra basis. So we really theoretically have to have a situation where we've got additional basis coming in because we've contributed boot rather than receiving boot. So we've got an asset that has previously been depreciated. It's being traded for a new replacement asset that's like kind. And the remaining basis of the original asset is going to stay in the books and it's going to continue to be depreciated using the same method and the same life that it was previously being used. So that means if it was 5-year property and it's 3 years into its life, that remaining basis will continue being depreciated for another 2 years until it's all used up. But any additional amount or boot brought to the table to pay for the additional cost of the replacement property, that will create a whole new line on the depreciation schedule, and the placed in service date will be on the date of the exchange. Rule number 11, sale of home. Additional rules apply to the sale of home if the home was acquired in a like-kind exchange. If you sell your home which is acquired in a like-kind exchange, you cannot claim the $250,000 or $500,000 exclusion if you sell the home within 5 years from the date that you acquired the home in the like-kind exchange. This rule also applies if you received your home as a gift from another person who acquired the home in a like-kind exchange. Rule number 12, report like-kind exchanges on Form 8824. And we're going to get a better look at the form in a bit. I just wanted to highlight for you the various sections of the form and what purpose they serve. Parts 1 and 2, and then 3, which is on page 2 of Form 8824, are used to report each exchange of business or investment property of a like kind. If during the current year you transferred property to another property in like kind exchange, you must file Form 8824 with your return for that year, and you also file Form 8824 for the 2 years following the year of a related party exchange. On lines 1 and 2, for real estate exchanges, provide the address and type of property. For personal property, enter a description. On line 5, the written agreement identifying replacement property must be signed by all parties to the agreement not later than 45 days after the transfer of property given up in the exchange. Line number 6, the replacement property must be received by the earlier of 180 days after the date the old property is transferred or the due date of the return, including extensions for the year the old property was given up. And then we've got lines 7 through 11. A related party includes your spouse, child, grandchild, brother, sister, parent, grandparent, S corporation, partnership, corporation, anything that you hold an interest in. And an indirect exchange with a related party includes an exchange made through an intermediary or an exchange made by a disregarded entity, such as a single-member LLC, if you or a related party owned that entity. An exchange between related parties will generally qualify for non-recognition treatment if the property or properties which are exchanged are held for 2 years or more by the related parties. A disposition of any kind within 2 years by either of the related parties causes the deferred income to become taxable in the year of the disposition. Moving on to page 2, in part 3, line 12, you are asked to enter the fair market value of the other property given up in the exchange. On line 13, you need to enter the adjusted basis of the other property that has been given up. And it's this number or the amount that you enter on line 13 that can be a challenge. And 1031 Corporation is just one of the many sites I found on the internet that really has a wealth of information on like-kind exchanges. And in the manual here, I have a link that you can click on. And I noticed yesterday when I clicked on the link, it did work, but it gave me all these warnings that their site was not certified or something weird like that. If you get alarmed by that, that's something for you to be concerned about. But at any rate, I clicked on it. The worksheet opened just as it always has for me in earlier years. And what the worksheet does is it's someone who's just taken an Excel program. It's an Excel program. And they've programmed it so that you can make entries of various types of costs and features that you will then use to figure the amount to enter on each of these lines. So the worksheet can be helpful if you're a little bit unsure about what you need to do. So at any rate, if you go to this worksheet for the 1031 exchange and you click on it and you spend some time working with it, what you will find is it's just step-by-step working like an IRS worksheet to help you figure out how much to enter on each of these highlighted lines. Because how much you enter on these lines is the question mark that has my head scratching. And the worksheet is just merely a tool that you can use to do that. And I don't have the worksheet filled out anywhere in our class today. I'm just kind of telling you the link to it. But I kind of do the similar concept for you in the illustration that I'll have coming up in just a minute. But at any rate, line 12, you enter the fair market value of other property given up in the exchange. On line 13, you enter the adjusted basis of the other property given up. On line 15, you include the sum of any cash paid to you by the other party, the fair market value of other not like-kind property you received, if any, and net liability assumed by the other party that is more than the total of any liabilities you assumed, cash you paid to the other party, and the fair market value of the other not like-kind property that you gave up. You then reduce the sum of the above amounts, but not below zero, by any exchange expenses that you incurred. And then on line 18, you're going to enter the adjusted basis of the property you gave up, the exchange expenses, if any, except those that were used to reduce an amount on line 15, the net amount paid by the other party, the excess, if any, of the total of any liabilities you assumed, cash you paid to the other party, and the fair market value of other not like-kind property that you gave up over any other liabilities assumed by the other party. Now, the IRS instructions for line 18 provide an example of treatment of other property. In referring to the example, though, you should note that the example shows a situation where each party to the transaction assumes the loan of the other party, and there's no reference to independent financing through a third-party mortgage company. I comment on this because I certainly think about it, well, if I'm not assuming the debt of the other party, rather I've got a debt that is going to be paid off and I'm taking out a whole new debt, and both those debts are by me, how does that play into the calculation? Well, the very conservative approach is to say it does play into the calculation and to treat it just exactly as the IRS illustration is demonstrating, even though the illustration is not identical to the typical type of financing that most people have. So here is the promised illustration of how to complete an 8824. And in this illustration, I've used colored boxes to kind of highlight key points that you need to be using to calculate what amounts you need to be entering on each line of Form 8824. Detailed illustration. During the year, Joe C. Wales traded his commercial building for an apartment building in a like-kind exchange using a qualified intermediary. Use the following information to prepare his 8824. And we've got the purchase date of the property given up and the date identified for the property he's receiving. Then we have the sales price, the closing costs, and the agent commissions on the property that he's given up, as well as the purchase price and the closing costs on the purchase of the property he's acquiring. Then in green, I have all three of these things highlighted because they kind of all tie together. We have the purchase price of the old property, accumulated depreciation on the old property, and a cash down payment made on the new property. So this is basis in the old, this is a reduction to basis in the old, and this is cash being brought to the table on the new, all of which will affect basis. Then we have the mortgage on the old property. That was $150,000, and he's going to take out a mortgage on the new property of $316,000. The date of the transfer is 10/1/12, and the date of the property received is the same date. So that's a simultaneous exchange. When completing the 8824, we need to assume the following. Closing costs for the sale of the commercial building and the purchase of the apartment building will be paid in full from the cash down payment and the new mortgage. The old mortgage is paid off by the proceeds from the new mortgage. And here we have the adjusted basis of the building. So I said you take 300, subtract out 70, you get 230. We then have additional money borrowed. The mortgage on the old property was $150,000, and the mortgage taken out on the new property is $316,000. The additional money borrowed is $166,000, so that $166,000 will add to basis. So ultimately, we take the adjusted basis on the commercial building, we add the cash down payment on the new building, we add the additional money borrowed for the new building to get the adjusted basis of the new building, which is $406,000. And we're doing all of this to basically figure out what line 18 of Form 8824 should look like. So when you're done completing Form 8824, line 18 should have $406,000 on it. How do we figure out the amount for line 19? Well, to figure the amount to enter on line 18, we start with the sales price of the old building, and then we subtract out the adjusted basis of the old building. We subtract out the closing costs and the agent commissions to get the profit on the sale of the old building. And the profit on the sale is $606,000. The whole point of a like-kind exchange is to not have to include that $606,000 in income. So if it's a qualifying exchange and we're not dealing with any boot being received, then we're not going to have to include any of the $606,000 in income. Then we have the fair market value of the property that Josie received, and this is the number that we need to enter on line 16 of 8824. We begin with the purchase price of the apartment, $1 million, and then we add closing costs on purchase of $12 to get the fair market value of the property received, which is $1,012,000. So ultimately, we then move over to 8824. We fill out Part 1 by entering the information that I've provided you. This is not a related party exchange, so we skip through Part 2, and then we get over to Page 2. And on Page 2, on line 16, we enter the fair market value of the like-kind property that you received, and that was the very last box I showed you on the preceding page. That's where you take the purchase price of the new property and add in closing costs on the new property to get the fair market value of the property received, which is $1,012,000. We then, on line 19, enter the realized gain on the commercial building as $606,000. But to get that, we have to know what to enter on line 18, and that meant on line 18, we had to figure the adjusted basis of the like-kind property you gave up, plus amounts paid to the other party, plus any exchange expenses not used on any other line. And when we added all of those numbers up, we got $406,000. So $406,000 is subtracted from $1,012,000, and that gives us the gain of $606,000. The $606,000 is deferred, and the basis of the new property is $406,000. So as a final resting point, what we would be looking at is that we have the original basis in the old property was $230,000, and that original basis is now going to be a part of the basis in the new property, but we're going to continue to depreciate $230,000 based on the original depreciation schedule in place for the old building. And then for the additional cost of the new building, we now have 10 plus 166 that's going to be depreciated for the cost of the new building over time. And that's it. That concludes the like-kind exchanges. Okay, so the question I'm seeing is, when you perform a 1031 exchange in a partnership, can you specially allocate the gain and deferred gain to specific partners? So what you're saying is the partnership does a like-kind exchange? Okay, so if the partnership owns property that is dealt with in a like-kind exchange, you're going to have to look to the partnership agreement and basis rules to determine who gets the benefit. Partnerships are incredibly complex animals, and it's a difficult question to answer without knowing a whole lot more about that partnership, because you have all the basis calculations that have to go on all the time for all the partners, and also what the partnership agreement has to say about their profit sharing and their loss sharing and their capital contributions. So it's a really difficult question to answer. It's potentially possible if everything were orchestrated correctly, but you could have one partner, for example, who has contributed all of the capital. And therefore, the partnership agreement could say that loss sharing will apply to the partner who has the capital, where profit sharing will be shared equally. You can arrange it that way, but it needs to be documented. There needs to be some formula that's in play. Can anyone be a qualified intermediary? I would say that anyone could be a qualified intermediary. They'd have to research the rules to see what a qualified intermediary is required to do. I've never researched that. It's just been my experience here in Oregon. Title companies usually perfect real estate transactions. In other states, sometimes attorneys are the ones that do it. So it could vary by state as to who the state allows to do that type of transaction on a professional level. And in terms of what the IRS defines as a qualified intermediary, I've never actually had to look into that. It would be something you'd have to look into. I think it's a pretty risky thing. You have to have enough money on hand, and I think it's a fairly complex thing to do. That's why I told you that company called 1031 Exchange, I think it is. Let me just pull that up and share my screen a little bit. And there's 1031cpas.com, 1031corp.com. These are groups out there that their entire specialty, the thing they do, is a like-kind exchange. And they're really good at it, and they have a lot of information on it. And so any questions that you have that I couldn't answer and that IRS instructions don't answer, because IRS instructions, quite frankly, are absolutely dreadful. Although, as I said, these guys are not an official source that you could ever reference, I feel I can have confidence in a company that has made it their mission to know everything there is to know and is dealing with high-end clients on a regular basis. They probably have a grasp on things. And here you have this tax resources link in here. They've got the IRS Form 8824. And somewhere in here they have worksheets. And rather than find the worksheet for you, again, I inserted a link to it in the manual. You just click on the link. But these are the people, and there are other people like them that have a lot of resources available to you. A dealership is not a qualified intermediary. They're different. A qualified intermediary is a third party who's not actually interested in owning property on either end. The dealership has a car that you want, and in exchange for that car, you're going to trade in your old car, and so they take ownership of the old car. They actually are the end recipient, and in and of their own right, they will sell that car on their own, but there's no job on your part to go out there and find the person who's going to buy that car from the dealership. The dealership will take responsibility for that. Whereas in a like-kind exchange where you're using an intermediary, you've got the property you're selling and you've identified the property you want to buy, but the owner of that property doesn't want to trade for your property, so you bring the qualified intermediary in to perfect that. Whereas with a dealership on cars, you have your car, you go to the dealership, and the dealership takes that car as trade-in, and you walk away with a new car. And what that dealership does with your old car, you don't have any impact on that. You haven't found another buyer for that car. The dealership owns the car. So they are not a qualified intermediary. They are a direct party to the like-kind exchange. Puppy. Puppy. Puppy.